surrounding it. The backdrop for the Fed decision, of course, is the banking turmoil as of late. Fed Chair Jay Powell's comments today set for intense scrutiny after the collapse of SVB and the fear it created over contagion to the wider financial system. That's not even bringing in Credit Suisse and UBS, et cetera, to the whole situation. Let's sort of take a step back and look at what's gotten us here. Joining us now is David Gura, NPR business desk correspondent. David, formerly an anchor at MSNBC and a correspondent for Bloomberg Television and Radio, which is where I got to know him, former colleague of mine. Dave, good to see you. So in your reporting, as this is all unfolded, sort of how are you thinking about it as we are now at a point where there's some relative calm?
I mean, it's been a wild ride just because so much of this has been sentiment driven, as you know, Julie. And I think that that's kind of like we're at this point now where you say this is the backdrop to what's happening at this meeting, and a backdrop I think that the Fed chair is going to feel duty bound to. Kind of like we're at this point now where you say this is the backdrop to what's happening at this meeting, where you've got policymakers and lawmakers feel duty bound. Kind of like we're at this point now where you say this is the backdrop to what's happening at this meeting, where you've got policymakers and lawmakers feel duty bound. Kind of like we're at this point now where you say this is the backdrop to what's happening at this meeting, where you've got policymakers and lawmakers feel duty bound. Kind of like yesterday coming out in that speech before the American Bankers Association talking about how the government stands ready, basically, to intervene if this were similar circumstances were to befall other smaller banks. So, this impulse to look forward and look back. And in the moment here, I think we are at a point where I don't know if cooler heads are prevailing, but folks are exhaling after what's been a pretty wild, bumpy ride here over the last, 10, 11 days.
David, what do you think the biggest lesson learned, perhaps, that banks are going to be able to take away from the turmoil that's ensued here?
I mean, I think that for a couple of things. First of all, I'm struck by how this has sort of highlighted once again this divide between what goes on in Washington, what goes on the West Coast. I think that can't be overplayed. The fact that there has been this uneasy relationship between tech and Silicon Valley and Washington policy, and certainly the postmortem that's taking place inside the Fed that Michael Barr is running is going to look at how the San Francisco Fed and other policymakers made missteps clearly and were unable to see the problems with this balance sheet. I've been struck just looking back on what the chair of the FDIC said over the last year, warning about the sort of bond risks that Silicon Valley Bank had to deal with. I think that somebody told me earlier this week that this is kind of a show me story for banks right now, that there's this impulse on the part of customers to know, they want to know that their banks are safe and the balance sheets are safe. And I think that as a result of this, banks have learned a lesson that they have to be more forthright about where they stand, and they have to be more nimble about being in communication with their customers to show sort of how their portfolios stand and what their balance sheets look like.
Well, and I also think it's uncovered, maybe there's a lot of banking customers who don't necessarily understand the business model of banks, right? That they don't keep all of your money sitting in a vault somewhere, that they're actually using it to make their own money out in the market or what have you in other investments. And I wonder if you've talked to folks who have pulled deposits or considered pulling deposits and what that sounded like.
I think that's absolutely true. I myself haven't talked to a lot of customers who are in that position, but I have colleagues who have. And I think there was that immediate sense of worry because I think a lot of people just aren't even familiar with the basics of sort of what the FDIC customarily insures or doesn't. And there was this fear in the aftermath, obviously, that even if you didn't have 250,000 or more in Silicon Valley Bank or Signature Bank or any of these other smaller regional banks, you were worried about there being any kind of backstop to that. So, yeah, I think that this is a moment when a lot of people are seeing the need to learn more about the way the banking system works and what's taken care of, what's insured and what's not. And, I think looking at the other side of that coin, I think that the government and regulators might see this as a lesson on their part to look more carefully at how that stuff is communicated, how people understand the way that banks work. Your point is a really good one, Julie, about sort of the fact that you think that you're locking up your money and, maybe it's being lent out to other customers of the bank, but by and large, it's pretty safe. And I think that, this added layer of how this kind of surge of cash for these banks was deployed into these low interest securities is something that I think a lot of people are just sort of coming around to and trying to figure out and understand. And, I don't know how long lasting that will be, but I think it certainly was a wake up call for a lot of customers.
And so now, even with the uninsured deposits that have been put forward from a range of banks, about 11 of them, I believe, to the tune of $30 billion towards First Republic in itself, and now thinking more broadly about what that could do in terms of turning into an injection of capital, an infusion of capital, I believe, as they put it. Now the larger question is, what does this mean in terms of the options for some of the regional banks, even to just navigate this interim crisis, as some have called it, even as one of our guests has said he hesitates to call it a crisis earlier this week.
Yeah, it's been interesting. Like the semantics of this have been really wild. We've debated internally, just to be candid, whether we call it that. Accepting the fact, acknowledging the fact that this is not like 2008. Sort of, is crisis the right term here? I think another thing we're kind of watching unfold here is how slow these regulators tend to move and the government apparatus tends to move. So yeah, there is this fear among a number of these kind of mega regional banks, First Republic primarily, of what's going to happen here. As you say, there's this discussion about a second deal following on that $30 billion cash infusion, what that looks like. I think that there is, as there often is the case, companies want to see the government match the urgency that they're feeling at this time. We're seeing that now. I don't know how all of that pans out, but it was astonishing to me twofold. Like after the collapse of Silicon Valley Bank and Signature Bank, you had First Republic essentially doing the right thing, lining up financing from JP Morgan and the Fed and acknowledging the fact that they could get more through this new facility. And yet investors didn't buy it when the markets opened on Monday. And you saw the same kind of thing play out after this deal was announced that was brokered by Jamie Dimon of JP Morgan, this $30 billion deal. There was this immediate celebration that followed that statement from the Federal Reserve, the Treasury, and the FDIC welcoming what these banks had put together. And yet the market reaction certainly wasn't as strong as I think both the banks that came together and those regulators thought it would be. So again, I go back to what I said just at the beginning, which is like sentiment is a real devil in all of this. And it's a real lesson, again, as many people have learned before, but I think for a lot of people it's new, just how when there's a bank run, that contagion can spread, and a bank run is really hard to slow down as it moves from bank to bank to bank.
David, great to get your insight and perspective around all of what is continuing to play out even now. David Gura, NPR Business Desk correspondent. Thanks so much for joining us this morning.
Nice to see you.
Good to see you. And let's continue our conversation on the financial fallout that began with the collapse of Silicon Valley Bank and the subsequent stabilization efforts put in place by banks and governments, both here and abroad. Joining us now for a global look, Gillian Tett, editorial board chair and editor-at-large for the U.S. at the Financial Times, Dylan Ratigan, who is the host of Truth or Skepticism on Tasty Trade, and Peter Tout Larson, who is the global editor at Reuters Breaking Views. Thank you all for joining us this morning. Gillian, first, I want to begin with you. Earlier this week, we had State Street Global Advisors Michael Aroni, who said he saw no reason to panic here, and particularly around the crisis word. I want to play this clip and get your reaction on the other side.
I think that it's clear that government officials, central banks, and even the banking sector is doing everything they can to contain I even hesitate to call it a crisis, the challenges within the regional bank sector. And Julie, just a moment ago, you were pointing out, even today, if we look at those regional banks, a number of them are up so far this morning.
And so there's been a lot of semantics about whether or not we should be calling this a crisis, but the reality here is that there's a magnitude of impacts, and many still asking if there's an sensationalization of the turmoil warranted, considering those web of impacted parties. Would love to get your perspective.
Well, the good news is that we are seeing some recovery in bank shares and signs, according to the US Treasury, that the outflow of deposits has slowed down overall, although we can't get a breakdown in terms of individual banks, and it's still very unclear what's happening at First Republic. The other bit of good news is that some kind of deal has been cobbled together in Switzerland, albeit very, very controversially. The bad news, though, is that, as you've just heard, the reaction in the markets to this extraordinary attempted rescue of First Republic has not been as nearly as positive as the government had hoped. First Republic still is clearly very, very challenged. And the other bit of bad news is that there's still a sense that the interest rate problems that caused the issues initially at Silicon Valley Bank are still bubbling at many, many other regional banks. And on top of that, there's a really big question, which is, given that this has primarily been an interest rate risk linked crisis, and that's what's caused the liquidity problems at the banks, are we now going to see this morph into a credit problem, whereby we begin to see, unfortunately, some of the losses, or some of the loans that banks have made have problems?
And Peter, I want to bring you into this because as we sort of look at the international banking system, the Credit Suisse, UBS, situation seems to have stemmed the bleeding, so to speak, for now. You have that on top of some of the regional banks in the U.S. still perhaps being troubled. Sort of what's the global view on stability, on financial stability right now?
Well, I think there's a couple of things. I mean, part of it is just, the sort of the weakest wildebeest at the back of the pack are getting eaten, basically, right? I mean, Credit Suisse has had problems for a long time. Silicon Valley Bank was the one that had the greatest exposure in terms of unrealized losses on long-dated securities. So those things tend to go first. The question then is really whether, to what extent that spreads. I think there's a couple of ways in which that could happen. One is in the US, obviously, this question over uninsured deposits and whether they're at risk, which the authorities are doing their utmost to try and calm people down on. The other point of contagion potentially is what happened in Switzerland over the weekend, which was the Swiss government's decision to write down to zero these additional capital bonds that Credit Suisse had issued, basically by changing the law over the weekend. And now everybody asking the question across Europe and elsewhere, sort of, could that happen here as well? So I think those are the immediate factors. And then, but the underlying point in all of this is interest rates are rising, and we've had, a decade and a half of ultra low interest rates. And the Credit Suisse and SVB situations show you that people are not prepared for that to happen. And so the consequences of that will continue to filter through.
And so, Peter, as well, kind of thinking through where the contagion has actually led to already, as Dylan was mentioning a moment ago, some consolidation, or even after that consolidation, what can be expected by clients of these banks to the service level agreement that they should be able to uphold their financial institutions to as well?
Well, I think it depends. I mean, the interesting Credit Suisse and SVB are very different, but one thing they had in common is that they both catered to very wealthy clients, right? I mean, in Credit Suisse's case, millionaires and billionaires, and SVB obviously had all these venture capital firms and startups depositing their money with it. So they were probably particularly susceptible to a run in a sort of an online, people being very aware of what's going on type of world. I think the other question here, though, is that we've seen in both cases, despite everything that happened after 2008 and all the regulations that were passed and so forth, we're still seeing essentially the authorities coming to the rescue. Right. I mean, in the case of SVB, they stepped in and guaranteed the deposits. And in this case of Credit Suisse, basically UBS was ordered to buy Credit Suisse, and the Swiss government then changed all kinds of laws in order to allow that to happen quickly. So we're still slightly in the sort of the 2008 playbook, which is the government is ultimately there on the hook. And if that is the case, then I think that probably also changes the way people think about different governments and their ability to support their banking systems.
Yeah, on that front, Dylan, let's bring you into this. It's good to see you, by the way. It's been a while. As we mentioned, you're host of a podcast called Truth or Skepticism. So let's bring in some skepticism. You in the past have been critical of, particularly following the 2008 crisis, critical of sort of the system, the regulatory framework. Do you think that was really a failure that led to maybe not just SVB, but also in some ways Credit Suisse?
Oh yeah, I mean, it's not even a question. It's not an opinion. They chose to create two classes of banks in 2008. Those that are too big to fail. There are four of them, and then they created everybody else, and that was their solution. They said, "Well, we're going to ratify." Rahm Emanuel said in the meeting for Dodd-Frank, "If you vote for this bill, you will never have to have another TARP vote again as long as you live, because we can directly connect the Federal Reserve to the big banks and bail them out without anybody knowing." That was the law that was passed in 2008. And so you had two classes of bank. Now you fast forward, the second class of banks, pick them, we're using these names that are the ones now, well, they fail. Well, guess what? They're also insured 100%. I think that the charade that every bank is not completely supported is not helpful. Because we're sort of pretending like, oh, capitalism, and oh, you have your money, you fail your money, you lose your money. And not true, not true. The way it works is if you work at a bank, you can create more risk two ways. credit risk, which is what they did in 08, you reduce your credit quality, or duration risk, which what Peter just referenced here, which is you go into longer dated investments and in their case, and in many cases, don't hedge. When you create more risk, whether through duration or credit risk, and you're a bank CEO, bank board member, bank executive, you pay yourself millions or tens of millions of dollars a year, each year, and it lasts for 3, 4, 5, 6, 7, 8, 9, 10 years. And at the end of that, because that is a terrible way to manage risk, when you fail, the government will bail you out. That's the global banking system. That's not I don't care what the rules say. If you run a bank, the logical incentive is to manufacture risk and compensate yourself as much as possible until it finally blows up. The bank will then be bailed out. The equity might be dissolved, but there will never be compensation clawbacks. And the consequence of this is you have bankers that are incentivized to manufacture risk that can be transferred to the government rather than provide a service, which is to facilitate the flow of credit and capital to actual enterprises. Enterprise business, whether it's the startups of Silicon Valley or whether it's industrial manufacturing. We started a glove manufacturer. We had a $50 million contract from the Pentagon. Can you imagine if we had to go to 50 different banks to try to manage all of our vendors because it's the depositor's responsibility to manage risk? It's laughable. And so I think that this is a good opportunity if people want to understand that the banking system is completely backstopped everywhere, that the implication that some are and some are not is useful for the more powerful. So we want people to perceive at First Republic to be vulnerable because other banks want to buy it for free. Every time that it gets a little squirrely, if you pretend to be capitalist for a few weeks, you're able to knock off the weak wildebeest, as Peter said, buy them out for cheap, and then the buyer gets bailed out, whether it's UBS that takes the Credit Suisse book or whatever's going to happen with all of this. But I think we do ourselves a disservice to pretend that that's not the world we live in.
And Jillian, I want to kind of pivot to you and perhaps even get your reaction to that with the added thought of some economists saying that the banking sector turmoil has done the Fed's job for it. Do you believe that to be true?
Well, it's done the Fed's job for it in the sense that it's tightened financial conditions really quite considerably. And there are analysts out there reckoning that the financial tightening is equivalent to around 25, 50 basis points hike as it is. But the issue for the Fed right now is that it's quite keen to separate out financial stability from the real economy insofar as it can. Of course, you never really can. But as Christine Lagarde of the European Central Bank said last week, there are different tasks for the Fed right now. So I suspect what the Fed will do is essentially continue to raise rates to signal its fight against inflation. So use a policy rate tool to basically try and go after inflation, but use its balance sheet to essentially try and stave off the financial instability risks. And we've seen that already. It's going to be very, very difficult. I'm very strongly in the camp of those who think the Fed made a terrible mistake to keep interest rates so low for so long. The reason we're having these shocks now is because it's had to overreact and jam on the brakes to essentially atone for the big mistake it made earlier. And I strongly agree with Peter that the fundamental problem, as I've written myself in numerous columns, is that most of the financial system has been geared to make a one-way bet on rates staying low forever, and they simply have not woken up yet to the risk. And the really big issue is that, yes, we started.
I would just argue they're aware of the risk. I would argue, Jillian, they're aware of the risk, but they're expecting the bailout. In other words, there's ignorance, and then there's just these are not stupid people. These are people that benefited from the credit expansion in 2006, 7, 8, 9. Then there was a massive overcompensation, which was the zero rates to compensate for their previous mess, which everybody agrees the Fed is out of control, running zero and getting all these more. And now, First Republic has mortgages out in California for 2.5%, and their borrowing rates are 5.5% at the short end. That's not a shock, right? At some point, rates were going to go up. I'm arguing that the risk is egregiously mismanaged, whether it was going into 2006, 7, 8, 9, with the credit, with the ninja loans, or whether it's the leverage on short rates now because they know they're going to get bailed out.
Well, and Jillian, is that the risk then of the FDIC making the guarantee more explicit and saying there's no limit, let's just guarantee all deposits? Is that the risk then, that you are encouraging further risk-taking behavior?
Well, the only thing that's worse than moral hazard, which the system is riddled with right now, is that you have unpredictable moral hazard. And that's worse than moral hazard. Because yes, at the moment, we now know, in retrospect, that the depositors at Silicon Valley Bank and Signature were rescued. Yes, Janet Yellen said yesterday that that rescue, that support, will extend to other regional banks if they fall into problems too. But we don't actually know how far the FDIC support goes, whether it's going to cover all the banks. And perhaps most critically of all, although we've seen the banks break first in relation to the interest rate cycle going up, or interest rates going up, and we're seeing some protection for them, what's going to happen if, say, commercial real estate starts breaking big time, as we've heard earlier, it may well start to do? What are we going to do about private equity, venture capital? What are we going to do about university foundations? There are many, many parts of the financial system right now which could also be hurt very badly by interest rates going up. And we just don't know whether the government's going to step in and provide that kind of moral hazard or support or bailout there as well. So for investors, it's incredibly confusing because you could neither trust on free market mechanisms to set the price of things completely. We've seen with the Credit Suisse UBS deal that the government stepped in and meddled there extremely extensively. So you can't really trust free market mechanisms, but you just don't know yet whether the government is actually going to come out and bail out the entire system or just select pieces.
Well, actually, Dylan, I want to let Peter get in.
I have to emphasize, this is worst case scenario. What Jillian described, which is stochastic moral hazard, is the worst potential economic policy you can imagine.
Right.
Stochastic is a big word, but yes.
So, Peter, I wanted to bring you in here for the last word because what Dylan and Jillian are talking about is indeed a worst case scenario, right? It's sort of a dire scenario. Do you think that's what's going to happen? Is that what we're headed into here? Or what do the next 3 to 6 months even look like?
I mean, look, it's very difficult to predict, but I think Jillian made the important point just now, which is that we're talking about the banking system, but I think we can all agree the banking system is I mean, it's not safe, but it's safer than it was in 2008. In 2008, the banking system was at the heart of the problems. And I think the banking system until now has been a bit more of a shock absorber. And okay, we'll see how that goes and whether there are other things lurking on the balance sheets that come to light that make this a more serious problem for a bigger number of banks. But what's happened since 2008, quite deliberately, the regulators designed it this way, is that they've pushed a lot of risk out of the banking system and into financial markets, into funds, into private equity, into various other things, and hedge funds and so forth. And that was very deliberate because the idea was that those entities would not put consumers at risk in quite the same way. But it hasn't quite worked that way. And we've seen a couple of times now, most notably in 2020 during the COVID pandemic, that the central banks had to come in and backstop financial market instruments in order to prevent fallout and prevent damage to the economy. And so I think that's the other big lurking risk here is what other unexploded landmines are there out there that are beyond the reach of the financial regulators directly, but that they may have to come in and take care of if it turns into a real problem for the economy.
Yeah, I think that one thing we've learned throughout the past, 20 years plus of covering finances, they'll find new ways to take on risk that we haven't necessarily foreseen. Thanks, guys. Really great to get your collective perspective here.
Thank you.
Dylan Ratigan, host of Truth or Skepticism on Tasty Trade, Peter Thal-Larsen of Reuters Breaking Views, and Jillian Tett of the Financial Times. Thanks again, guys. Coming up, Moderna is defending its COVID-19 vaccine price hikes before the Senate. Our Anjali Kamlani has the latest next.
5% is a good number.
Ron, we are, I think a lot of folks can agree, in some form of banking crisis. It's been a challenging 2 weeks for the financial services industry. Is this the moment where you're huddled up with your CFO, thinking about your balance sheet, how much debt you have on your balance sheet, how many stores you have open, and how are you thinking about just protecting your business moving forward?
Yeah, so let me break that into two pieces. First, from a banking standpoint, the vast majority of our deposits are with the large national players, top-tier players, and we have no exposure to any of the banks that have been discussed over the last few days. Secondly, that's why we're so thrilled that our cash flow was strong, because we paid down an incremental 35 last week, and we committed to 100 because we are seeing such positive cash flow trends. We also put a collar on our debt to cap the impact from any future interest rate hikes. So we've really insulated ourselves from that. We're focused on operating the business, and delivering a 5% comp, I think, is good operating the business.
I guess I would ask if you're making any changes operationally, right? Are you changing the mix of products that you're putting out there to adjust as people are buying fewer discretionary items, for example? Are you cutting back on staff at all? Are you cutting back on CapEx plans at all? Any kind of changes you're making with the view of some of this changing spending patterns that you're seeing?
Yeah, we got smarter about some of the capital expenditures. Last year, we put 1,000 coolers in, so we already did that. We had some IT debt, so we were able to take some of those capital dollars and reinvest them against our debt, as well as against our veterinary network investments. We are supplementing our what I call the OPP, opening price point, for more customers. And then we're really driving customers towards Vital Care, where they can save $400 a year through free exams, grooming, and training discounts. But in turn, we get a greater share of wallet. So 30% of those Vital Care customers are new to food with us, 40% are new to services with us, which is a good thing for our business. So the customer wins and we win.
Ron, always great to get an update and get some time with you. Petco CEO Ron Coughlin alongside Yahoo Finance's Brian Sozzi. Thanks so much.
Thank you.
Switching gears, everyone. 2022, it was a tough year for retirement savers. The average balances for 401k and IRA accounts, they sank by more than 20%, according to Fidelity Investment Analysis. And 2023's turmoil has not helped. Here to talk retirement tax strategy is Tim Spiess, who is the partner in charge, much different title there, Tim, partner in charge over at Eisner Ramper's Personal Wealth Advisors Group. He joins us as part of our Taxes Made Simple segment brought to you by Fidelity Investments. Okay, so first thing that people need to know as we are squarely in the throes of this tax season and people are getting ready.
Now, all this after Silicon Valley Bank's collapse created a contagion effect with repercussions felt around the world. Here with more, Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. Fed officials meeting right now in arguably one of the most uncertain policy meetings in years. Typically going into a policy meeting, Fed officials clearly telegraph their intentions for the policy meeting. But we were in a quiet period when Silicon Valley Bank failed, touching off contagion in the banking sector, ultimately leaving a lot of question marks around what the Fed will do today. Before Silicon Valley Bank's failure just 2 weeks ago, Fed Chair Powell had opened the door to what markets interpreted as a 50 basis point rate hike. And given strong CPI and jobs reports from February, that might have been on the table absent a banking crisis. Today, markets now largely expect the Fed to raise its benchmark interest rate by 1/4 percentage point to a new range of 4 3/4 and 5%. But there are a range of views. In the 25 basis point rate hike camp, we've got Piper Sandler, JP Morgan, Morgan Stanley, and Wilmington Trust, all noting that high inflation keeps pressure on the Fed to hike. In the no hike camp, Goldman Sachs expects the Fed to pause, citing stress in the banking system, this down from their previous call for a 25 basis point rate hike. Now, one outlier, Nomura Securities, which is calling for a 25 basis point rate cut and a halt in the Fed's quantitative tightening program in March due to the financial stability risks in the banking system. Now, questions are also swirling about what sort of combination the Fed could pull here. Is it raise by 25 basis points and stop QT, or is it raise by 25 but lower their interest rate expectations significantly? Today, investors will receive officials' new projections for how high the central bank expects to ultimately raise rates. 3 weeks ago, Fed Chair Powell had signaled rates would need to be raised higher than the range of 5 to 5.25 penciled in back in December. We will understand just how those bank failures are influencing the Fed's monetary policy when that decision comes down at 2 p.m. Eastern, followed by Fed Chair's press conference at 2:30 p.m. The suspense is killing us. I know. Rochelle, back to you.
Indeed, it certainly seems to be killing some of the mood in the markets at the moment, the closer we get. Jennifer Schonberger there, thank you so much. Well, constructive action by regulators to support the US banking system after Silicon Valley Bank's collapse hasn't been enough to calm markets or ease insolvency fears among investors or bank depositors. Still, officials are focusing on restoring confidence. Treasury Secretary Janet Yellen spoke on the subject yesterday in her keynote address at the American Banking Association's Washington Summit. Take a listen.
Our banking system is sound, even as it's come under some pressure. As I indicated, this is different than 2008. 2008 was a solvency crisis. Rather, what we're seeing are contagious bank runs. We demonstrated last week that the federal government is resolutely committed to taking actions that will mitigate financial stability risks where that's necessary. And every step we have taken has been intended to reassure the public that our banking system is resilient and that we stand behind the banking system.
Well, joining us now to discuss the path ahead as the Fed looks to balance the bank stability crisis as well as inflation is ABRDN research economist Abigail Watt. Abigail, thank you for joining me this morning. So as we look at this balancing act, what are you expecting to hear from Jay Powell in terms of the narrative? We know investors will all be listening very closely.
Yeah, look, I think this obviously, as you've said, is a really pivotal meeting for the Fed. Our expectations are that the Fed will deliver a 25 basis point hike, but clearly, I mean, the decision is likely on a knife edge for the Fed today. And I think in terms of their communication and how they kind of handle the press conference, I think if they choose to deliver that 25 basis point hike, then I think they're likely to kind of focus a lot more on the financial stability concerns, pushing towards kind of saying around the different tools that they have to deal with those financial stability concerns, and I guess separating the kind of fight on inflation from the kind of ongoing turmoil in the banking sector. But if they choose to not hike, then I think the press conference tone could be very different. I think they'll likely be much more hawkish in their stance in the press conference, and I think that's likely because they still have that inflation fight to go somewhat, and I think they would be conscious that pause should be predicated on the view that they will then return to hiking again once markets have calmed a little.
And it's tough because, the Fed was accused of being behind the ball when it came to recognizing how sticky inflation was going to be. So now at this point, then, depending on what they do, as we've seen across the camp, a lot of different views on what the Fed could and should do at this meeting. How much of the Fed's credibility is on the line?
I think it's a really good question, and I think this is perhaps slightly why we're erring towards the 25 basis point hike, because I think the fundamentals in the economy, we saw kind of stickier inflation, we've seen the labor market tightness persisting, and we've seen activity actually holding up fairly well into the turn of the year. And so I think in terms of the Fed's credibility, they'll be really conscious of that inflation fight and the fact that is ongoing. And I think if you think about the turmoil in the banking sector, I think as well, not hiking, does that suggest to investors that the Fed are more concerned than they perhaps currently think they are? And I think that it will be in a really important balancing act for the Fed today.
And of course, everyone keeping an eye on recession risk. Data from Bank of America researchers seeing an uptick in recession risk. 42% of fund managers surveyed predict a recession within the next 12 months. And it was just at 24% in February. How have your recession expectations changed?
So we've been expecting the US to enter a recession since June last year. We originally projected that they would enter that recession by Q2 this year. We saw the strength of the data at the beginning of the year and we pushed that back. But I think there's a question as to whether some of the turmoil you've seen in the banking sector actually pulls forward the timing of that recession. So whether we see the US enter a recession over the summer instead. I think in terms of how that's shifting, how this is shifting our expectations of a recession, I think the way that we think about it is actually that some of the tightening that we're likely to see in credit conditions off the back of the banking sector turmoil might do some of the Fed's work for it. We might see kind of that tightening in financial conditions feed into the real economy a little faster, and then the Fed likely doesn't have to hike rates as much as we had originally expected them to.
So then beyond this meeting then, we know that Jennifer was talking about that sort of that formula of trying to manage inflation while also trying to decide what to do with quantitative tightening or easing there. What is your outlook on that?
So given we're expecting the US to enter a recession, and that recession that we're predicting is a run-of-the-mill recession, we're expecting a peak to trough decline in activity of around 2%. We expect that will have labour market impacts, and we think that ultimately some of the loosening in the labour market that will happen through that recession will lead to inflation eventually undershooting the Fed's target. And in that environment, we think it's highly likely that the Fed will cut rates back down to the zero lower bound. This is somewhere where we've had a little bit of pushback in terms of the extent to which we think the Fed will loosen policy. But I think it's likely that given the recession that we're forecasting, if that is realized, then we think the Fed will have to kind of loosen policy again through 2024.
And as we look at how some of these central banks are really addressing this, I mean, we saw the ECB determined to stay the course, even in the midst of Credit Suisse's collapse, still going for that 50 basis point hike. What are we seeing in terms of central bank coordination on this, or are we in a sort of uncharted territory?
Yeah, I think it's a really interesting question, because I think it also has implications for the Bank of England tomorrow. And I think the ECB kind of paved the way for the path for the Fed in terms of being able to kind of separate the financial stability and the inflation concerns at today's meeting. And I think if the Fed were to not hike 25 basis points today, then I think that kind of has knock-on implications for the Bank of England's meeting tomorrow. Obviously we saw the upside surprise in the inflation data out of the Bank of England today, out of the UK today. And I think that all things said, I think the Bank of England should be hiking 25 basis points tomorrow. But I do think you're right that there is perhaps a kind of knock-on effect if the Fed do not hike today.
We'll certainly be keeping an eye on that. ABRDN research economist Abigail Watt, thank you for joining me this morning.
Thank you.
You're very welcome. All right, Krispy Kreme getting a sweet upgrade. Truist raises their rating on the stock to buy from hold. As analyst Chappelle notes, Krispy Kreme should be one of the few packaged goods companies that will post meaningful volume growth in 2023. Now, Truist also pointing to the brand's refreshed strategy and expansion opportunities, positioning the company well over the coming years. All right, coming up, are there opportunities for investing despite the current banking crisis? Stay tuned as we discuss next. CEO. Good to see you, Laureen. So obviously we do have a lot of different camps sort of trying to figure out what the Fed is going to do next, how long this banking crisis is going to play out. Where do you see the opportunities in this environment?
Well, there are a lot of opportunities. And what I think a lot of investors are going to miss is we now have Treasury Secretary indicating, in effect, that there's a backstop. And there's this new banking program that is going to offer $2 trillion to swap out securities out of banks and give them cash. And with that, that's effectively another way of saying QE, quantitative easing, versus QT, quantitative tightening. And with that, QE offers a tailwind in the markets. So with that, I think that we are going to see a tailwind. I also think as far as looking at fixed income, longer duration assets, both on the income side as well as the equity side, are going to benefit. So what does that mean? That means going out longer in duration on fixed income and looking at some technology names that benefit from long duration assets.
And Lorraine, as you mentioned, Treasury Secretary Yellen there, obviously really focusing on these banks that have this systemic risk in terms of the ones that would qualify potentially for another backstop, SVB style. But then you also have SoFi offering access to up to $2 million in FDIC insurance for checking and savings. So when you have some of these banks sort of doing their own thing, and you also have this idea that some banks, the ones that have more systemic significance, are also in the picture to get more protection, what does that do then in terms of the investment landscape?
Well, it's good that we have banks that are offering the kind of security that people are looking for, because what is going on right now is there's a lot of money movement from the smaller regional banks to the large national banks. And with that, that's going to cause more stress to the regional bank system. So with that, a lot of the regional banks are talking to their clients, letting them know what additional security they may be offering. But from an individual or a business owner, they do need to be looking at their bank. They need to be looking at the strength of their bank and seeing what guarantees do they have. And if they're holding excess reserves more than $250,000, they need to know if there's any additional assurances. Because there hasn't been, that's where we're seeing a lot of movement. So from an investment landscape, I think there's still quite a bit of fallout for regional banks. And I think that there needs to be caution around trying to invest in that arena until some of this is sorted through. Of course, looking at the details, looking at the balance sheet, looking at the 10Ks, if you're interested, you can look at those publicly traded banks to see the strength of those banks. And with that, because there's been such a fallout, there are some regional banks that are quite strong that are being impacted on their stock price. So there could be that opportunity, but I would say you need to be cautious in the area of regional banks.
And I mean, even when people have been looking for safe havens, usually it's bonds, but when you think of the inflation risk attached to that, makes it less of a safe haven here. Where do you see the safe havens when you do have this sort of backdrop?
Well, the backdrop that we're looking at is most likely going into a recession. And so thinking about defensive areas of the market, like consumer staples, and being careful with valuations in that area, and then looking at healthcare as another defensive position. And then selectively, like I said, areas of technology, I think could be a valuable play as well. But definitely looking at a defensive measure when it comes to equity exposure.
And Lorraine, what are you steering clear of at the moment as well?
Well, I think we're steering clear of utilities and areas that are more cyclical. Those would be areas that we are avoiding right now. Another area I will say that could have opportunity are real estate investments that have already been impacted by a fast interest rate increase environment and those rate hikes, and now offering long-term leases, and some of those companies could be attractive as well.
Of course, all eyes going to be on that Fed announcement that's coming out today. I mean, a lot of people, just the difference a week makes, roll in on a 50 basis point hike. Now we're at the 25 basis point hike point. But would anything other than a quarter point hike, say a pause or a cut, what would that do to markets?
Yeah, I think that could be harmful in the sense that it would let the markets know that they're not really as serious about taming inflation. And so, and that could be problematic longer term. So I think it is 25 basis points, and you're absolutely right. We keep moving, the ball keeps moving. We thought it was going to be 50. Now we're back down to thinking it's going to be 25 after the banking crisis that we've experienced in the last few weeks. So with that, I think the Fed needs to stand firm, saying, look, we're still fighting inflation, and balancing it with, we're not going to try and destroy the economy and destroy the banking system. And so that is that fine line that they have to play, but 25 basis points could do that.
All right, we'll certainly be keeping an eye on it. Laureen Gilbert there, thank you so much. Wealthwise Financial CEO, thank you for your time this morning. All right, let's check in on the markets here, sponsored by Tasty Trade. We see that mixed picture now with the S&P also turning red, although fluctuating there, relatively flat. The Dow there, though, accelerating some losses there.
To have your assets in a wallet. Like years later, we still were investing strategy into crypto.
On the landscape, we welcome in crypto prices in focus ahead of the Fed meeting today. As you can see, all of them moving to the upside there, the major cryptocurrencies. So for more on the landscape, we welcome in Kiana Danielle, CEO of InvestDiva and author of Cryptocurrency Investing for Dummies. You did the first edition, but you also have the second edition coming out in March as well. Thank you for joining me this morning. So Kiana, a lot of people, they're seeing this rise of Bitcoin. They're saying, is this the time to jump in? What should people be doing with their Bitcoin at the moment?
Well, thank you for having me. And it's interesting because I literally asked on my social media, what do you think about crypto? And the very interesting thing is my first edition of my book came in crypto winter and nobody was interested. And then the crypto boom happened. And then now we're in winter again and the second edition came out. What should they be doing with the crypto they already have is a very different question than should they get in or not. If they already have crypto, depending on what kind of crypto they have, I would always recommend never to sell for a loss. Like that is literally Warren Buffett's first law of investing. I know he's not into crypto, but I actually do apply his investing strategy into cryptocurrency markets. And I typically try not to, I never sell at a loss. So if you have invested in a crypto asset that you were confident in, there was a reason why you got in. Hopefully there was a good reason why you got in. It wasn't like a hype or FOMO kind of thing, but it was like a real reason. You really believed in that asset. You really believed in the ideology and you want to be a part of the future, then you probably want to hold on to it. Now, if you're not in the cryptocurrency market, as the previous speaker was also saying, I also agree that there is a very, very high chance that we are going to be heading into a recession. So we are approaching our portfolios also with a more precaution and allocating and diversifying among other assets as well. And I could go deeper in that if you would like to.
Well, I want to first talk about some of the coins that you do like, because obviously, you know, Bitcoin is its own sort of monster. But then when you look at things like Ethereum and the use cases there, what are the coins that you like at the moment?
So I first heard about Bitcoin about in 2011. I was like, this is way too risky for me. I'm not going to get into it until 2016 that I dove like really into it. And I fell in love with it. And the reason for that was because of my background. And now this may or may not really resonate with anybody else, but I was born and raised in Iran to a Jewish family after the 1979 revolution when the new government of Iran took over. And my dad before that, he was a very successful CEO of a successful company, had a lot of money in Iran, in the bank account, and in their house, in his office. And after the revolution, the new government came in, seized all of his assets, seized his bank accounts, everything that he had. And I remember even after I was born, like years later, we still were keeping like my mom's jewelry and Persian carpets and like piano, things like that in our friend's house, because at any moment the government would come and raid our house to take anything that we would have. So this went on for 10 years. And 2016, when I was reading about Bitcoin and how decentralized it is, and the government cannot just come and take it from you, because you can, if you have put it in a safe place, that is, a crypto wallet. Right. There was like my dad, even if he had like half, like a portion of his assets in something like Bitcoin, if it existed at that time, we wouldn't have had so much problems with money. So in America, it's a little bit harder to understand understand this concept. But for me, Bitcoin really became something of a safety net, just in case everything goes down.
And to that point, obviously, with a lot of the volatility that we saw from the banks and the fallout from SVB, we did see that flood into it. We did sort of have that resurrected, that narrative of Bitcoin and crypto being a safe haven. But I do want to ask you, though, in terms of what people should be identifying, if they already have crypto or if they're thinking about getting into it, you've identified some of the deadly mistakes that you tend to see people make in this space. Lay those out for us.
Oh, yeah, absolutely. So here's the thing with any kind of investing, whether it's stocks, it's cryptocurrencies, it's bonds, it's private equity, it's real estate. The number one deadly mistake is falling for hype and FOMO. Like that is literally the number one. If you don't understand what the asset is, like if you don't understand what crypto is, until you really understand it, don't get into it. Just because Elon Musk said so, or like, we had GameStop, we had this, we had that. Falling for hype and FOMO is the number one deadliest mistake. Why? Because even if you like fall for the right hype or right FOMO, and it's like the right good asset to be in, but because you didn't have the fundamental understanding about that asset, and if you're in it for the long game, which is the kind of investor that I am, I'm a long-term value investor. Once things go down, if you only got into that asset because somebody that your like cousin said so, you are going to get emotional, and emotions are what are going to wreck your portfolio. So to avoid that emotion, you need to handle your emotion before anything happens. You need to get in with the right understanding of what that asset is, what it means to you, how much confidence you have in that asset. So that is a number one deadly mistake people make. And the reason why all of these things happen, because with the SVB, people are like, oh my gosh, high yields, let's go into it. Everybody is doing it. No, I didn't go to SVB because I'm like, cool, but it really doesn't align with my values. So I didn't do that, right? The second one is not protecting your asset. Again, I've been like yelling this out of the roof. You need to have your crypto, like the reason why you have crypto in your portfolio would be for security reasons and for diversification and for protection against the middleman. You need to have your assets in a wallet, in a crypto wallet. A crypto wallet is something like a USB that you transfer your assets, and then now you are the owner. The bank can't touch it, the government can't touch it, and whatever happens to the outside world, to all of the scams or whatever that is happening, your crypto would be safe. So get a crypto wallet. Don't keep it, no matter how much of a high yield they give you.
And Kiana, we only have time for one more, so we're getting your top three here. Just very quickly, as we're running out of time. What is your third?
I would just give you the third most important one. Absolutely, not knowing your risk tolerance. Understand your risk tolerance. Your risk tolerance is not just your emotions, it's your ability and willingness to take a risk. So at Investiva, that is literally what I teach. You need to know why you're getting in to something and measure your risk tolerance, your current financial situation, what your goal is, and then decide whether or not you should add cryptocurrency to your portfolio.
Certainly makes a difference if you're the long-term holding sort of investor. Otherwise, you're panicking every time you see a move in crypto. Kiana, Danielle, thank you so much for your time here on Yahoo Finance.
Thank you.
All right, Amazon, you're very welcome. Amazon is doubling down on its Fire TV business as the company announced it's expanding its line of televisions. Yahoo Finance's Ali Garfinkel is following the story and joins us now for more. Hey, Ali.
Hi, Rochelle. So the number of Amazon Fire TVs sold globally has officially surpassed 200 million. Now, what does that mean? Today, apparently,
Non-profit organization Khan Academy has wide eyes for the future of artificial intelligence. It's testing a new virtual tutor and classroom assistant using OpenAI's latest education technology. Now, this comes as schools across the country voice their concerns on AI in the classroom. Cities like New York, Los Angeles, and Seattle have moved to ban ChatGPT in the classroom, and universities in India and France took the same measures. Let's bring in Khan Academy founder and CEO Sal Khan to discuss this. Good to see you here today, Sal. So you seem to be taking a very different approach from a lot of the critics that we've seen out there about having ChatGPT and its use in schools. Talk about your role in this and how you're really viewing how this could be used in your classrooms.
Yeah, a lot of these school districts and systems band it on the premise that students will be able to cheat and cheat in an untrackable way, and to some degree, that's not false. We've actually been working with OpenAI for about 6 months now. It feels great to not be an NDA anymore, so I can talk about what we've been up to. So well before ChatGPT came out, and we immediately saw with the GPT-4 technology that it's more nuanced, it's better at math, that we could actually make it so it's not helping students to cheat, but it's actually just helping students to learn, to be as a tutor, to do novel activities. And so when we launched Conmigo, which we're rolling out, there's a waiting list for it right now, as part of the GPT-4 launch last week, we've actually been doing demos with some of the very same school districts that you just listed that banned ChatGPT. And their response has been, this is exactly what we wanted, because we're showing them that, hey, instead of writing the paper for the student, it can write the paper with the student. And the teachers and the student and the parents can have oversight over what's actually going. They can actually see the transcripts, that it can act as a tutor. This has been a bit of a holy grail in EdTech for a very, very long time. And even after the pandemic, a lot of folks have talked about how do you get tutoring to help kids with all of the pandemic learning loss. And so when we showed this to school districts, I'm doing 3 or 4 demos to district leaders almost every day, they're saying, oh, wow, this actually threads the needle for us, because we realize there's a lot of benefit, but this mitigates the risks.
And it's interesting because a lot of people think of this as support for students, but also for teachers as well. We saw how strained a lot of public schools were, especially amid the pandemic. Talk about that aspect.
Yeah, at Khan Academy, we've always positioned ourselves as we want to be every student on the planet's tutor, accessible, and for every teacher. We don't view this as a replacement for the teacher. We view this as an assistant for the teacher. I think every teacher would love to personalize things for their students more, to give every student more attention, or to have essentially a teaching assistant or many teaching assistants in their classroom. And this is what that does. The average teacher spends almost half of their time, 30, 40, 50% of their time, doing things like lesson plans, grading papers, et cetera. This technology, there's older technology that could do some of this, but this technology really starts to be able to help teachers develop lesson plans, not in hours, but in seconds, minutes, allows teachers to get assessment in ways and get grade things that weren't gradable before, like free response and essays. So a lot of what we're launching with Conmigo are actually teacher-facing tools. A lot of times, teachers are the secondary thought. We would definitely want to put the teachers first in this, because we think it's important. One, if they save more time, it's more time that they can spend with the student, and also the more that the trust that they have in these types of technologies, the more likely that kids are going to be able to leverage them.
And obviously, with every advance that comes with AI, a lot of people sort of look ahead and think, what's next? Not just for where AI can take us, but also some of the dangers. We know Bill Gates recently spoke about that in an op-ed, and we know that he has donated, the Gates Foundation has donated to Khan Academy. Talk about that dichotomy of sort of wanting to push the boundaries with AI and what we can do, and sort of really managing some of the risks that also come with it.
Yeah, the primary risks are it can make up facts. The hallucination is literally the technical term for when these large language models do that. Historically, large language models have not been good at mathematics. There's always been a fear that maybe it could introduce some form of bias. And these are all real risks. And what we're doing is trying to minimize them as much as possible. GPT-4 does a lot less of, let's call it, the hallucination behavior than what you saw in previous generations. On the math side, it's a lot better. And we're doing a lot of things on the Khan Academy side where we are able to improve the math accuracy and be able to have it act as a nuanced tutor in ways that you couldn't do previously with large language models. In terms of bias, in terms of students maybe trying to do things that are inappropriate, this is where we have a very strong moderation filter. Teachers, parents can monitor what students are doing. And if the students get into a particularly unproductive or even potentially dangerous conversation, it immediately flags the teachers and parents. So these are the types of safeguards that, once again, when we're showing these school districts, we're showing teachers, they're saying, wow, this is exactly what we need, because 40% of our teachers are already using ChatGPT. So it's not like, despite the bans, folks aren't using it. And these are the teachers who are using it. But they just wanted safeguards. They wanted to be more pedagogically positive, not just something that just gives answers. And we're able to introduce novel activities that didn't exist before, like students being able to interview historical characters or literary characters, or being able to get into a debate and fine-tune their arguments on things that you traditionally couldn't have done with EdTech.
So then when you think about the classrooms of the future and where we are now, just as we're looking at ChatGPT 4, which is already leaps and bounds of what we saw with ChatGPT 3.5, how do you see the future of classrooms looking?
Yeah, it's really an extension of what we've always been preaching here at Khan Academy. The future would be kids able to learn at their own time and pace, real student-centered learning. I always say the best education for most of human history was to have a tutor who caters their education to what you need. If you haven't mastered a concept, they'll slow down. If you find something easy, they're going to speed up. Industrial Revolution, we had mass public education. It was a great thing, but we had to make compromises. We batched students together. We moved them lockstep. I think the classroom of the future is going to be what Alexander the Great had with Aristotle, but you're going to have that for all 30 students in the classroom, where they're going to leverage Khanmigo, they're going to leverage other tools that Khan Academy has to learn at their own time and pace, but then the teacher is still in control, but the teacher isn't lecturing anymore. The teacher is able to use the information, they're able to talk to the artificial intelligence. What are my students up to? What do you suggest I could work with them on? Just what a good teaching assistant would do. And then they could do a Socratic dialogue, a game, a simulation. They could go sit next to 5 students and do a more focused intervention, or maybe motivate them, while the other 20 or 25 students are able to continue to work for the next 10 or 15 minutes with the artificial intelligence with Khan Academy. Things that I thought weren't going to happen for 20 or 30 years, I think are going to happen in the next 5 years. We're already working on ways that the artificial intelligence can have a more persistent memory, so it can start to understand what's going to help the students more over longer periods of time. We're making it ways for the teacher to be able to have conversations with the artificial intelligence about what the students are up to. Similarly, for the parents to have conversations with them. Ways for the artificial intelligence to actually moderate conversations amongst the human beings. You can imagine a teacher, and I hope to have this in place in the next year, where a teacher says, hey, artificial intelligence, hey, Khanmigo, I want you to break up my class of 30 into groups of 2 or 3, and I want you to moderate a conversation with every group of 2 or 3, have them debate an issue, have them brainstorm something, have them come to their own conclusions, and then you're just going to report back to me, the teacher. You, Khanmigo, the AI, are going to report back to me, the teacher, of what have the students been up to? What are some of the stronger arguments? What students have been struggling? And I think this will make every teacher's job that much more fun.
I can imagine that also being translated to news anchors, moderating panels and doing interviews. The future's looking very interesting indeed. A big thank you there. Khan Academy founder and CEO Sal Khan, thank you for your time this morning.
Thank you.
All right, coming up, we check in on the markets ahead of the noon hour and get you set for the rest of the trading day. Stick around.
Playing a role when you've got this kind of upside.
Yeah, for Virgin Orbit, the story has been and continues to be the headwinds that they face as a result of their own launches, and those launches not going successfully, and how costly those launches are. So impacting the amount of cash that they are able to still deploy just to operate on a day in, day out basis and make sure that they can pay people at the end of the day. And so within that, I think it's really just a matter of how they are able to shore up capital in this near-term period of time and get confidence from any lender that would be able to give them that infusion of capital, that they're going to be able to be paid back one day. And the, of course, alternative, as we have seen over the past week, is far more dire when you do have a company that essentially says, all right, yeah, we got to shut down the operation just to figure out how we can go on existing. But it's a significant mission that the company holds on to, and trying to make sure that within all of the launches and the satellites that are a larger component in the payload that they're trying to put into orbit as well. I mean, it could pay off, but it's just a matter of when, how, and will they have enough capital and cash to deploy towards just that operation and making sure that it's sustainable over a long-term period of time to get to profitability.
Well, today, the stock's going to the moon.
No.
Sorry.
As they say, get to banks in our ears.
Yeah.
Guys, let's check in the latest market action in the banking sector as well. Investors are looking ahead to today's Fed decision, and we've got even more of this movement that's taking place in the regional banks. You flagged PacWest Bancorp as well, and we're seeing that move lower here pre-market by about 8%.
Yeah, although the company said it secured some cash from a financing facility, $1.4 billion in cash. It's got a financing facility from Atlas SP Partners. Maybe what's weighing on the bank is that at the same time it's making an announcement that its deposits fell by 20%, and it had been trying separately to raise capital in different ways, and that is not working out. So I suspect that is what's going on here and why the stock is trading so much lower in pre-market trading, despite raising some capital or getting financing in a different way here.
Yeah, $3.7 billion borrowed from the Federal Home Loan Bank System, and then $10.5 billion from the Federal Reserve's discount window, plus $2.1 billion in Bank Term Funding Program. That was as of March 20. And so the investors are going to continue to have to look at the injection of capital that needs to come post textbook bank run for not just First Republic that we had seen, for PacWest, and then additionally for Silicon Valley Bank that led to its own collapse. These are bank runs where you see an extreme and volatile volume of the amount of deposits that come forward, and then essentially thereafter it's just a matter of, okay, do we have enough cash for our day-to-day, any type of deposits or withdrawals that we might be exposed to as well, and being able to cash in on those.
Right, and part of the question is, where is that money going, right? There's some concern. The guests we've talked to are saying if it goes to bigger banks, then are those bigger banks even bigger, and is that more of a systemic risk? But some of it must undoubtedly be flowing to other small banks as well. Again, I'm looking at the Wi-Fi Interactive, and PacWest is now down some 47% year to date. If you look at that, and some of the other regional banks have just been knocked around pretty acutely. That said, if you look at other regional banks this morning, they are not all trading lower. So that's perhaps encouraging here that you don't have this wholesale selling that we were seeing earlier in this crisis. There you've got the opening bell on Wall Street as we check the markets, sponsored by Tasty Trade on this Fed day. On Fed days, you tend to see a little bit of pause, right? Not a lot of action in the markets until we hear from the Federal Reserve. And as we look at the opening bell and where we are trading here today, that is the case once again, right? We've got not much change here. The S&P and the NASDAQ, well, I was going to say they were both lower, but now the S&P is lower again. They're bouncing around the unchanged line is basically how we can put it here. And that's because for the first time in a while, there is some actual suspense around what the Federal Reserve will do. It does seem consensus has coalesced around a quarter-point rate hike today, being announced later today. However, there is still, the chance that something could be said in the press conference that could affect stocks in an unexpected way. There's always that chance, but today there seems to be, Brad, more of that chance than usual.
Yeah, bouncing around. Of course, a technical term for the markets coined by NERD and Rihanna. Dow Jones Industrial Average, you're seeing that flat as of right now here. Still holding on to some gains just ever so slightly over the past 3 days. Still higher by about 2.25%, just a little bit more than that. The NASDAQ composite, you're seeing that flat, but to the downside for the tech-heavy average this morning, out of the gate down by about 6 points. But over the past 3 days, in context here, still higher by about 1.9%. And the S&P 500, you're seeing that here on this hump day up over the past 3 days, but here on this hump day, it is flat to the downside by about 0.1%. We'll round that off too. Also want to take a look at some of the sector activity that we're seeing out of the gate this morning. 11 S&P 500 sectors. You know what the deal is, folks. We've got them pulled up on your screen here. XLRE pulling up the caboose. That's down by about 1.2%. But hey, look no further than some staples. It seems like there might be a little bit of a retreat to those staples this morning. At least it's up by about 0.1% and is leading the charge here among among the S&P 500 11 sectors, but more laggards than gainers. Overall, the index is lower. Taking a look at some of the tech moves that we're seeing out of the gate here and focusing in on some of the mega cap tech names, Microsoft, Alphabet, both of those lower here to start off the day. Alphabet down by a little bit more than 1%. Apple holding on to slight gains. That is up by about 0.1%. I didn't touch anything but the screen change, so we're just going to go back to it for a hot second here and take a look at Tesla and how that's doing on the day. And here's why: 0.6% in the move higher here on the day. But I'd also been tracking this one yesterday for a little bit. Let's just see how it's performing on the week. Over the past 3 days, up by about 10%. Pretty significant move that we're seeing there on Tesla, even as Elon continues to tweet about his own economic inclinations or projections. And so we'll continue to watch that, as well as Meta. Meta's been seeing an interesting move on the week. Of course, you had that call yesterday that really gave Reels a little bit of a sentiment boost there, but ultimately over the past 3 days up by about 4% for Meta Platforms, Facebook Meta, whatever you're calling them at home. Call them up this week.
Whatever we're calling it now, exactly. It looks like KeyBank also turning bullish on Meta shares this morning, and so that doesn't hurt matters. Seems like a lot of people are there's some positive chatter. Not so positive, however, on our next mover, and that's Luminar. Shares are sliding after Goldman Sachs downgraded the tech company to a sell, saying it's fully valued and it's going to face greater margin pressure. Luminar shares down some 7% here this morning. The analyst over there, Mark Delaney, saying that they can continue to see Luminar as one of a handful of leaders in the very competitive LiDAR industry. That's a quote from the note here. However, it really has to do with the company's margin outlook, revenue per vehicle, and also they're looking at what has happened with the stock and that the stock is now more fully valued. So all of that affecting the shares here this morning. I hadn't had a chance yet to check to see if there are any other sells on Luminar, but it's interesting to get this kind of a call on the company.
Yeah, within the note.
It's the only one. It's the only one. Only sell on the company.
Only sell. Okay, singular. Lone wolf out there, or lone bear. But Luminar attributing this higher average selling price in part to software, the note had also said, and they also believe it's got some opportunities in that regard. The market for the software is highly competitive, and they also believe underlying hardware gross margins, tailwinds from software, it could be lower than the company targets there. And so that is within the note, but they ultimately think that the current valuation is expensive right now.
Yeah, the stock is up, even with today's drop, 56% this year.
Interesting.
I mean, it's down over the last year, I believe, like so many of these tech
51, I
stocks. Yeah, 51% or so.
Yeah.
And then has had this rebound. So we'll see.
A lot to track in lasers, in the world of lasers, everyone. Yep. Also coming up, pause for thought. We're watching shares of Petco after a rough fourth quarter earnings. Oh yeah, they're all in there. We'll speak with its CEO in the next hour. Are investors barking up the wrong or right tree here? We're taking a look at shares. They're down by about 8%. But on the other side of the break, Yahoo Finance's Jared Blickery going to break down the latest market action ahead of the Fed decision at 2 p.m. Eastern Time. That's coming up on the other side of the short break.
But let's check out what has happened in my absence. This is over the last 5 days. I was last here Thursday afternoon. It's been up 3.5%. That is the NASDAQ. Dow, which has been lagging this year, that is up 2%, but I think investors will take that. And let me just show you what the sector action is today, and then I'll close on some longer-term outlooks here. Now, tech is in the green here, but just barely 14 basis points. Materials, staples, healthcare also slightly in the green. Real estate really taking it. That's down over almost 1.5%. Followed by utilities there. So a little bit, some of the defensive sectors in the rear might be what you would expect for this day, but not seeing any huge trends. NVIDIA up 1.5%, Tesla up 1%. But let me go back to the S&P 500 here and also take a look at, here's a 3-month chart. Now, let me just put a 1 year, and you can see over the last year, basically not a whole lot has happened. In fact, that goes back to the beginning of Jay Powell's efforts all the way towards the end of Q1 last year. But I want to show something that has developed in the market. This comes via Morgan Stanley. Here's a little note. 5 things that happen when the S&P 5, or excuse me, 5 things that happen when these 5 things are happening. Okay, so SPX, that's S&P 500 forward earnings, those are declining. That means that expectations of future earnings are going down. Yield curve has been inverted since last year. That's one of the things. Unemployment below average. That means that the economy is still primed, yet manufacturing PMI is going below 50. That means that we're seeing cracks in the manufacturing sector, plus 40% of banks tightening lending standards. So all of this points to the situation where we are now, that we still have a robust economy that is on the precipice of cracking. And when all of those 5 things are in effect, we usually, 6 months out, we usually have a decline of 4.5% in equities prices. So just something to consider there, guys.
We'll definitely consider it. But Jared, I got to ask you something else very important. Forget about all this market stuff. You are one of the privileged few to have attended the kickoff of the Taylor Swift tour in Arizona. Any impressions, any teasers for those who are hoping to go?
Absolutely amazing. You're not going to believe it unless you see it yourself. It is probably the most elaborate, incredible stadium show I've ever seen. Gail was there, Paramore opened up. I will say, heading into the concert though, prices were crashing. I was fortunate.
Really?
I was fortunate in that my overpriced tickets were never delivered to me. I was able to get a refund and repurchase tickets on the cheap that were much better in terms of seats.
Holy moly,
so
that is some news you can use right there.
I know, there are deals out there, and is that a symptom of the economy, that there's not as much play money out there and that these ticket prices are crashing? I don't know, but there are some deals out there. So
you flew out there, and your original tickets were never delivered to you.
When I landed on Friday, I had no tickets.
What?
So thank you, StubHub. But I was able to get one up, I would like to think, by getting better tickets at a better price.
So you got them for below face, or was there even face? Is face totally meaningless when it comes to
I don't even know. There is still a premium, and you have to pay these fees, like the StubHub fees are outrageous. But I can tell you that the tickets were selling for a multiple. The ones I eventually got were selling for a multiple of the price that I got them at.
We should blow out the next block. We can continue to talk about this. Yeah.
Jared, thank you. Forget about the Fed. Coming up, our next guest says the recession in the U.S. could be postponed for a few years. We'll speak with FundStrat's Mark Newton, check on some more charts. That's next.
Moral hazard is essentially when one entity engages in an activity of elevated or heightened risk, knowing that another party or entity is their safety net. So for instance, in my own consumption patterns in the past, I have been known to be a buyer of LL Bean boots. I've got the receipts, folks. And one of the policies was I bought a pair of LL Bean boots knowing that they had such a great return policy that I could go back at any time with no explanation and had some damaged boots and said, hey, you know what? I need some new boots because your policy said that I could do this. And so that is me exhibiting moral hazard. I've engaged in the heightened or elevated risky activity, but I knew that there was a policy to be my safety net and I could return those boots. Now, that LL Bean policy has since changed, and thank goodness for their own business. But at the end of the day, this still persists within banks who take on elevated risk in their lending practices or in the investments that they may make, knowing that they are so entrenched or their businesses touch so many parts of the economy that there will be other entities that step in to be their backstop or their safety net.
Investors are now widely expecting the Federal Reserve to lift rates by 25 basis points or a quarter percentage point at its Federal Open Market Committee meeting. Many now wonder what implications that could have for markets as well as the economy in the wake of Silicon Valley Bank's collapse, and whether a hike during this financial turmoil increases the odds of a recession. Joining now for more on what the market's technicals are suggesting is FundStrat Global Advisors Global Head of Technical Strategy, Mark Newton. Mark, thank you so much for being here. You definitely have brought us some charts that we should be watching here. Where do you want to start? What's the sort of foremost in your mind as we go into the Fed meeting?
Well, look, Fed days are always extraordinarily important, and which is a lot less than we've seen all year long. And also we know that really, the average movement is about 1.9%. Obviously Powell's comments are increasingly important in really helping to shape investors' expectations And so, that started during the Bernanke term back in 2011. So, obviously, a lot of volatility. We've had a big rally, about 200-point rally in the S&P since March the 13th. S&P is now up to what I believe is very important, sort of make or break levels for the market. Big move in technology. That's really been the area that's carried, the majority of the market. And of course, the most important being 27%. So it's going to be important to really see if the market can really follow through on this and see other sectors really start to help to carry the load outside of just technology.
Okay, and so we don't want to kind of belabor some of the charts that you've been looking at and the technical analysis here. And so you believe that stocks could take off this year, but within this, of course, we have to factor in a few things, one of which you were just walking through, falling interest rate expectations being a positive there. But then what else would you be keeping an eye on here?
Well, look, I think the consensus is right now that the market has it wrong, and that's really interesting. Everybody is really talking the same playbook that, earnings revisions have to continue to drop, that the Fed is going to hike us into a recession. There's a lot of doom and gloom for probably a lot of the right reasons. However, as we heard from Soros's famous protege, Druckenmiller, the economy of the stock market is the best economist I know. So, we really should be concentrating on levels of sentiment and what sentiment is teaching us about what investors think, rather than really debating whether it's going to be 25 basis points or zero. The labor market remains in very good shape. This is a very different economy than any of us have been used to in a long time. So we can't really use the same playbook to say that, we're going to have a recession or not. And you really have to follow really what the market's telling us. And the market has had a very good start to the year. Now we've had about a 6% drop from early February. However, technology has outperformed any other sector over the last month. It's been the number one sector. And we're starting to see some evidence of financials now. The banks are stabilizing. Healthcare, I sent you a chart on healthcare. I think that's important. That's the second largest group within the S&P. And now that's starting to show evidence of trying to stabilize and move higher. So this is a chart really of equal-weighted healthcare versus the equal-weighted S&P. So when you see these stocks within groups like medical devices and biotech starting to gain ground, that's a really important thing to concentrate on for investors, because that's a very, a very heavy sector within the S&P outside of technology.
And, we had up a chart of the S&P 500 year to date with some of your technical mapping on there. Can you walk us through what these lines are and what we should be watching, what all of this indicates?
Well, those of us that use technical analysis, we're apt to really draw trend lines connecting, the highest high to the high that precedes a low. Bottom line, you want to get an understanding of trends. Are the trends moving, up, down, or sideways? And so, the market's had a great bounce since last October, but recently we've been in consolidation mode since the beginning of February. So that upper line really is what a lot of investors consider to be trend line resistance. And in order to expect that this rally is going to continue, we actually need to get above that. That would provide, some firepower, some energy for investors to either climb on board or for shorts to be stopped out. And that will allow, the market continue to rise. But normally, having a sharp 200-point rally into a very important level, that's normally a time also when you could see profit taking and see a pullback. So, really a make or break, as I discussed, for regards to the S&P at this level, because we've had a decent bounce. And now, that the key is, can financials and the banks continue to, bounce at this point? And we've seen some evidence this morning that a few of them are under pressure yet again. And can healthcare continue? So technology being 28%, financials and healthcare are both about 12%. So that's over 50% of the market right there in just those three sectors. So incredibly important for investors to really understand the sector rotation and what's happening.
Mark, you also have a chart particularly tracking the 100-day moving average of Bitcoin. And Bitcoin, we know, has kind of broken through some of those resistance levels. And right now we're kind of sitting and watching and waiting to see if it will hold or hit above 30,000 and then maintain that level. What most notably, especially for those who would say, all right, well, technical analysis, when we have a different set of parameters than perhaps we've ever seen before, what is the case for the technical analysis, and especially for something that is as volatile as cryptocurrency and Bitcoin?
Well, Brad, I would first of all say that technical analysis is always useful for all investors to have an understanding of trend, and particularly with regards to cryptocurrencies where fundamentals might be less relevant to how the price moves on a day-to-day basis. Knowing, how, price starts to move and how it accelerates, and watching things like momentum and breadth and sentiment are very important. So look, Bitcoin has rallied. It's almost doubled from last November's lows. It's been up about nearly 10,000 points just since March 13th. So that certainly is causing investors to suddenly pay attention at a time when maybe they couldn't care less a few months ago. I would argue that the area right near 28, 29,000 is very important. We've had a very good lift off the lows, but it's gotten a bit overbought. And you look at just daily charts that really show the dramatic surge we've seen in Bitcoin, or we concentrate on just a weekly chart to show that 100-week moving average. I'm looking at things like Ethereum that are rapidly starting to maybe, come back into play and gain ground on Bitcoin after such a big move in Bitcoin in a short period of time.
Mark, good to see you. Thanks for this technical analysis, as you say, useful for many investors. Fundstrat's Global Head of Technical Strategy, Mark Newton. Thanks. Coming up, the aftermath of SVB's collapse. How did we get here and what's next? We'll have a panel of experts to break it down in the next hour. Stay tuned.
With companies to adopt a variety of use cases for AI that are specific to their business. But, every company has to get bought in. I think what's happened with ChatGPT and generative AI is we have come to the moment there's a broad horizontal use case that every company, no matter what industry it's in, can see the value of that. And I think this is what is really going to make the adoption of AI take off. And obviously, NVIDIA is very excited to be part of that.
NVIDIA has been talking about AI for a while now, but I think it's interesting that ChatGPT has sort of tipped the public consciousness, not just in consumer, but also in enterprise, and sort of opened the door for companies like NVIDIA or like Adobe, who we spoke to yesterday, to then, sell some of those products to their clients.
That's exactly what I wrote down. Adobe, Shutterstock, two of those instances where generative AI, especially within images, can serve a massive purpose for the broader marketing clouds and the creative suites that they offer right now. And so for NVIDIA and what they're doing with DGX Cloud, layering that into the different data centers that they operate. And for IBM, which is one of the more historical OGs within artificial intelligence as we had known it, especially in the cybersecurity landscape, there is still a ton that Big Blue can perhaps do to widen their own portfolio or client base, given what they have already had, and just walking into meetings saying, hey, we've been a categorical leader in this for about 2 decades now. So for the newest advancements in technology, I think on the generative AI front of that, it's been interesting to hear about where this will begin to become monetized for an Adobe, a Shutterstock, so forth.
All these companies want a piece, for sure. We're going to talk more about NVIDIA's strategy with respect to all of that and have a broader conversation about the chip industry. That's with Jensen Huang. I'll be talking with him, so will our Dan Halley. We're going to have that conversation for you at 4:10 p.m. Eastern today. Be sure to tune in then. Yahoo Finance is going to get a chance to talk to him about all of these issues.
Always got a solid leather jacket on, Jensen.
Yes, that's the signature look.
Yes, indeed. Guys, coming up, where will rates go next? Big question of the day, the week, you know it. We're going to speak with BlackRock's Rick Reeder on what to expect.
I'll be with you in a second, Leggies. Just getting set up.
Not much change today, and if you look at the sector breakdown here, real estate is the real standout to the downside, the biggest move by far that we are seeing in the major averages today in terms of the sectors in the S&P. Utilities also on the move, but the XLRE, that's the ETF that tracks real estate, down 1.75% today. And of course, we are also continuing to watch what's going on with the banks today as we watch attempts to stabilize the banking system, right? We got that report that PacWest was trying to tap into some new financing, continuing efforts to shore up First Republic as well. Here are some of the bigger banks here, and we don't see much move in them today, really, if you look at them, except for UBS, which it looks like is down by a little more than 3%. But if you look at some of the other regional banks that we have been watching, we continue to track those very closely. Just going to take it to an equal weight view here so we can see things a little more clearly. PacWest, which I mentioned, down some 4% in today's session, as it also talked about 20% of its deposits going out the door as a result of everything going on. And then First Republic is down about 3% or so today. We'll see how directly, or if at all, Jay Powell of the Fed addresses these issues today. There's one more thing I wanted to check on, and that's what's going on in the bond market. We're not seeing any change right now in the 10-year yield, around 3.6%. But you see on this one-year chart the sort of up and down movement that we've seen this year as people try to game out what the Fed is going to do. So let's talk more about that challenge that the Federal Reserve has today as Chair Powell gears up to deliver the decision on rate hikes. And really, there are sort of three masters, if you will, for the Fed right now. There is stability, pricing, keeping prices stable. There is keeping employment full. And now also there is ensuring potential stability in the financial system. Rick Reeder is with us, BlackRock Global Fixed Income Chief Investment Officer. Of those three masters.
Yo, can you hear me, legends? Absolute mental shit going on, legends. Oh my God. Pump it and then dump it. Lol. Support. Guys, look at that. Straight down to support here. Bounced off it. Massive trade to be made, and then boom. Can you guys hear me as well? Tell me in the chat if you can hear me. I'm going to start this in a minute. Let me drink some water. In the chat, hit me with a like. Hit me with a like, guys. Let's get to 500 likes. And tell me if you can hear me. I don't know if you can. And then we're going to get into this in a second. I think it actually starts in around 30 minutes. So we're going to see what happens. And, you know, guys, I'm actually thinking 0.25. But we might get a point, we won't get zero, and that would be crazy. Obviously, you know, it could be even a fucking... They could even pull back. So it really is up there in, you know, for... It's one of the moments right now where it is actually a gamble. Very, very difficult to know what's going to happen. They could completely surprise us, you know. So it's probably going to be 0.25, but like we'll see. It could be a big surprise. The market's going to react to that. I need to work out how to sort out this desktop audio so you can listen to it whilst I'm talking as well. I need to put some headphones in, I think, but I'll sort it out. And yeah, we'll do this in a second, guys. I'll leave this back on and I'll see you on the flippies, okay?
Ability, and then use the interest rate mechanism to try and bring down this stubborn inflation.
Rick, that started to get into my next question, which was really around the terminal rate. And in that bifurcated conversation, even if we did see 25 basis points today, could they effectively communicate a pause by saying they were going to keep the terminal rate at a specific level or not budge that?
So it's a great question. I mean, by the way, I don't think the delta to the markets on you go 25 or pause today, I don't think is that significant, because I think if you go 25 and you say, gosh, we're getting to the place where we're
I'm just trying to sort out the headphones right now, guys. Give me a second. I am here, leggies, but I'm trying to sort out the headphones. So I can play desktop audio as well. I don't know. That needs to be like that.
talk about the go forward and round. We don't need to raise rates that much further, and we're going to make sure that we've provided enough liquidity to the system to withstand some of these shocks.
Let's talk about those shocks for a moment, though, Rick, because does it feel like they're contained at this point? In other words, well, not everybody, but they're initially, of course, after sort of hair on fire running around, particularly, I would say, on the West Coast, right? It feels like in the markets and elsewhere, things have calmed down to a considerable extent. So is there even that urgency there for the Fed to do anything about this? Is it sort of fixed itself?
So, Julia, first of all, I find that markets can be incredibly fickle. And so what they do one day, I'd say this weekend, markets aren't open the weekend, but there was a lot of sweaty palms on the weekend as well, and a lot of work done that portfolio managers et al. Were doing over the weekend. So, listen, I think there is a structural issue today that is manifesting itself around. There's a lot of commercial real estate that's been financed over the last few years. When you raise rates this quickly, the interest-sensitive parts of the economy, and particularly where there's financing or leverage attached, that's where you create stress. That's not going away tomorrow. And so you described, some of the institutions that have, it's not just deposit outflow, but it's the fact that a lot of these rates were locked in 2020, 2021, when rates were significantly lower. And there's a structural problem with the interest-sensitive parts of the economy, particularly around real estate and most intensely commercial real estate. So that's it's pretty hard to fix all of that very quickly. Again, guarantees on deposits is a powerful way to slow that down. But by the way, you can invest in T-bills today. You can invest in buying things like commercial paper at behind 5%, at 5.25%, 5.5%. There's a lot of alternatives to deposits, and that today at today's market prices are pretty attractive. So you've got a structural dynamic in the system that's going to take some time to work through.
Yeah, Torsten Slok. The increase in money market funds and people putting money into that as an alternative as well. As I noted a few moments ago, the XLRE real estate stocks are doing poorly in particular today, perhaps reflecting some of what you're talking about with commercial real estate concerns. But is that a systemic risk, do you think? The idea of that repricing of some of these commercial real estate holdings?
So if you go back to 07, 08, you think about the size of the housing market relative to, roughly 3/4 of the wealth in the country by people is in the housing market. Commercial real estate is not nearly as intense to create what is a systemic problem. However, you get isolated pockets that can lead to contagion risk. Listen, I think, what we talked about is, you think about all these markets, and you think about the next, what happened the last 5 to 10 years of investing when rates are at 0 or 1% or very low and negative in Europe. You have a dynamic where you can finance things, commercial real estate, private equity, et cetera, and it's very, very attractive to do it. When you lift the risk-free rate and keep it at this level, all of a sudden those assets become very hard to roll over your financing. And that becomes like, where do you invest today? Gosh, it's pretty darn attractive to buy. You don't have to take a lot of liquidity risk, beta risk. You can invest in things at 5, 5.25, 5.5 that don't have a lot of risk. That changes the whole paradigm of real estate, mezzanine financing, equity financing. By the way, the stock market, I think the stock market's just, and we talked about it on your show in the last few months, it's just okay.
And that definitely feels like a decision a lot of people are making right now, Rick. Yeah. We are out of time for now. Rick Reeder, BlackRock Global Fixed Income Chief Investment Officer. Thanks a lot. Appreciate it. Carvana shares getting a lift this morning. That's a trending ticker after announcing it's offering note holders the option to exchange their unsecured notes at a premium to current trading prices. Exchanging note holders can receive new secured notes that would provide collateral while reducing Carvana's cash interest expense. The online used car retailer offering to exchange up to $1 billion of bond principal at below par prices as Carvana attempts a restructuring of its debt load. What does all of that mean? The market views Carvana as potentially having liquidity concerns. It's got a lot of debt, and so it is trying now to attempt to fix that. Coming up, the road ahead for the banking sector. We'll have a panel of experts to discuss the fallout of Silicon Valley Bank and what investors can expect in the aftermath. That's next.
Right, guys, can you hear me? I need to know whether you can hear me or not. I think I might have got the speaker setup sorted out so I can have the headphone in my ear and I can hear the frickin' meeting. Let me make sure I got that correctly done. Okay, maybe not. Doesn't seem to be working now. 1 second, leggies. Oh, it's coming up desktop. What's going on? Fuck's sake, legend, what's that? All right, legends, I'm back to square one. Yeah, the meeting starts in about 15 minutes, I think. Should be 8:30 p.m. where I'm at right now. But let me make sure this is all playing. Put that on live. I'm just going to have it on in my ear in the background, I think. Can you hear that, guys? If you can hear the sound from the computer as well as the sound from me, that'd be great if you could just tell me. You can hear both. I'll put the camera on as well. I think I've got the camera set up. Let me make sure this is all looking good. I know, obviously, Legends, this isn't the most scenic movement into a stream. I think it should be okay now. Can you see my face as well? So we have this really annoying background noise right now. Obviously, I can turn this down, so it could be like a lower volume. But we are going to have to deal with that. So I got the headphone in to get so I can hear, obviously, Mr. Powell. I want to hear Mr. Powell speak his shit whilst commentating on it myself throughout the meeting. Because obviously it's going to be quite interesting to see what happens on this one, because this is the first meeting I'm actually really interested in because of the scenario. Let me turn it off, actually. I can probably go to the volume. So it's a pretty interesting scenario as a whole, because I'll put it on a little bit just so I got a little bit, you know. Because it's quite uncertain what's going to happen. And obviously Bitcoin's going to be very volatile, you know, because what happens is when you get these big fucking announcements coming out, which are literally dictating the future of all interest of all dollars in circulating supply on planet Earth, which indirectly affect billions of people. There are going to be moments in the market where you're going to have some sort of volatility, and that's absolutely fine. We can trade that. I actually have my trading exchange up right now. This is a crazy move up and down as well. We can see here that we actually came down to support, guys. I'll just do a little bit of TA. I've worked out the audio I can get out. So, I'm actually short, guys, from around 28,550 because I'm thinking that it's basically a gamble, but if we do get a negative reaction from the Fed, or let's just say the reaction to the Fed's fund rate, increase or decrease, whatever it's going to be, is probably going to be an increase of 0.25. But I think there's going to be, generally how that's going to be perceived in crypto is probably some sort of downside. And also I do think this pop out above the parapet, so to speak. You have this resistance level here. We also have this very, very crucial yearly, I think it's actually the yearly open. I think it's actually an open or a close from multiple years ago. And this comes in correlating with the order block we have at around between $28,000 to $30,000. So this has been a significant deviation play. I've been making some money on these shorts along here. But we've actually now broken out of it. And I did a tweet earlier. If you guys can see the tweet, I'll go show you now. If you can see my screen. I'm looking for something like this, a pop out the parapet and then a dump back down after FOMC. We will see what we're going to get after the FOMC, but right now we are getting some weakness. We did have a very, very juicy wick there, so if you want a higher time frame on a daily, you're probably going to see quite a nice wick at the top there. You don't necessarily, if you're a bull, want to be seeing that type of price action on a daily wick. Obviously right now it's fine, because we still got a little bit of time left, but, if you're going to get some sort of shooting star at top of this on an ascending formation, it is looking pretty bearish. I don't want to call it too early because obviously we haven't done the meeting yet. And I think there's going to be a lot of volatility in the next few fucking minutes after we get this meeting out of the way. I don't know if it's actually live. Let me just click live and see if I think I have got it absolutely live right now. If any of you guys see it go live anywhere else before this stream here goes live, then tell me. Also, guys, in Bitcoin, looking at long to short ratio, you know, it is pretty mental where we're at right now. So there's going to be some volatility. There's a lot of open interest in the market right now. Everyone's shorting here. You know, we've got a lot of open interest sitting in the books. Actually 4 million just on Binance, and then 12 million. 12 billion, guys. Let's get it right. 4 million on Binance, but 12. Sorry. What are we doing here, sir? 12 billion, yeah, of course. And yeah, so I think there's going to be some volatility coming up on this announcement. Guys, tell me in the chat, what do you think? 0.25 or 0.00. It's going to be interesting. Hopefully you can all see everything nice and clearly on the screen, guys. I'm just going to comment on Powell's bollocks as he speaks. It is going to be coming up soon. When you hear those red markers, by the way, you can probably hear it on your end right now. That means you're getting some significant sell orders. Market sell orders at that, actually. So you can see here on mdxalgo.com, you can see the market sell orders coming in there. We have also got a pretty decent wick action on that as well. But the meeting is coming up, guys. You can see here that we have an ascending formation. We're just trying to hold this as support. And you can see on the lower time frames, actually, that it did come down to it beautifully and have that bounce off it. Very impulsy, that. You know, that's going to obviously be showing some divergences right now. Some bearish divergence you can see coming on that. Because you have a higher high very quickly. And then the prices come back down. You've got some bearish divergence. We'll see if we can hold this support level here, guys. Though, obviously, when you first came down to it, when I was streaming before, I was like, this is actually probably an area to buy a support. You got the move you wanted if you were long, and now you're back down to where you started. Let's have a look at the BitMEX liquidations. BitMEX liquidation notice being sent. Well, that's what's going to happen in a minute, of course. Like, that is absolutely crazy price action from Bitcoin. And we haven't even done the meeting yet. We haven't even started the meeting. 0.25% increase in the Federal Reserve's fund rate. So the interest rate, the Federal Reserve. At the moment, we're like 4%, so it'll go up. Actually, I think it's a bit higher than that. So what they're going to do is increase the interest rate up to 0.25%. Or we're going to get 0 where they won't increase it either. It's an important day because obviously this is one of those ones where we don't actually know. It's a lot more uncertain than usual what they're going to do, whether they raise or even they go down. But you know, in my opinion, it's probably going to be 0.25 or 0%. Those are the two most, I'd say the most probable ones, and then the 0.25 is probably the one I'll go for if I was going to bet on it. But I'm rather going to bet on the fucking Bitcoin price being volatile after we get something. Yeah, so what's that? It's not delayed. They just announced the number ahead of the live meeting. They did? Ah, shit. Where did they announce it? So the live meeting's done. 0.25, like I said. Yeah, that's the most probable one. I was going to bet on it. Where's the volatility? That was the volatility, was it? Well, okay. Well, that was... the rate's come out. The rate's done. But they did this last time. Let's have a look what he actually says in the meeting. Yeah, I know. That's what I'm saying. Everyone's saying 0.25%. Press conference is still to come. So we're just going to wait for the press conference. That's usually when they get some stuff, what he says anyway. So yeah, that's what I said literally a second ago. I said the most likely one will be 0.25%. If we get 0, it'll be more crazy. But, you know, at the end of the day, the market hasn't really reacted. I would say there's a bit of volatility right there. But... you know, let's see what he has to say in the conference. And also, to be generally, you know, to be completely frank, you know, 0.25% is what they were going to likely do anyway if there wasn't the banking contagion problem. Press in 8 minutes. Yeah, in 8 minutes. We've got 8 minutes to wait, guys. Yeah, look at that hourly there. That's a Darth Maul if you've fucking ever seen one. That is literally the Darth Maul of all Darth Mauls. You can see there's a wick on the top, wick on the bottom. The place where he holds the lightsaber in the middle. Yeah, if he winks and then he touches his nose, we'll see what happens, legends. It could get pretty nuts. So yeah, we've already had a little bit of volatility on that announcement. Obviously, at the pop and the, you know, that's what you always get. Let's have a look at the SPX as well, see what it did. It probably did exactly the same thing. Actually, it's had a nice move, actually, to be honest, to the upside. But SPX is always, okay, not always, but a lot of the time the SPX will go one way and it will do the complete opposite towards the end of the press conference. So we'll have to keep an eye on that in this video. You actually do have some sort of formation coming out here as well on SPX. So I'd say that it's probably likely, like I said in my previous videos, that support. And guys, I've been calling this from the very freaking beginning. You already know this. I've said that this level here for SPX is the support region looking to buy. You've got the bounce trade. It's unlikely it's just going to shoot to the moon from here. I even said in my previous video, guys, that I think it's probably coming back down for that lower high. And then actually that will be where we get the move. But you can see here, guys, it is actually formating. The formation we have, sir, here right now is a rising wedge. And I would say that these are, generally speaking, they are basically indicating to the market, or the price action is indicating to the people analyzing the market, that you are getting a little bit exhausted in terms of momentum. Okay, so we could see after this press conference this come down a little bit. That would be absolutely fine, because that would just mean we're looking for that higher low structure for support. And then it will give the bulls a little bit of time to recharge. You know, guys, when a market goes up, it's rallying, right? The buyers are buying. They're pressing the green button. They're exhausting. There's only so much money to go around, which people have. So if everyone's pressing the green button, then there's no more ammunition to go in. So when the market comes back down, right, people actually start clicking the red button, which means they're sellers. People who didn't buy the first rally come back in to buy at a higher price. And then people who already bought or then sold, they can then press the green button again. So what you're doing is, when you see these pullbacks for higher low, is you're seeing basically the uptrend. If you're in an uptrend, you can be in a downtrend as well. But in this specific scenario, if you're trying to break into an uptrend, you're just seeing, you're just giving the bulls that, a little bit, they're recharging and they're giving them a chance to then say, okay, look, now we've got some more ammunition to go for the next leg. SPX looking good, though. I've already said from the beginning, I think SPX is going to go and have a good first half of this year. Bitcoin, of course. Look at that 5-minute. Love it. If you zip out to the hourly, guys, I've had this on stream the whole entire time. This is kind of the formation we've had for the last, actually, it's been about, how long has it been now? It's probably been almost a week we've been doing this, maybe a little bit longer. And we have these higher lows coming in. Classic TA, guys, in terms of analyzing this market. You can just see there's a flat top of resistance. This is where the order block is for sells. We've just exhausted that order block, guys, by buyers beginning to step in higher and higher and higher and higher. Now you've had the pop, and then that's what you're looking for the fake out. And they usually get fake outs. That's what I've been calling on my Twitter. A pop and then a breakdown. And that's actually pretty much exactly what we're getting right now. We've got the area of resistance here. You've got the pop out. It's almost like the bird or, the mole popping his head above the parapet. And then the parapet, the head of the animal just gets blasted off. That's usually what happens with these breakout trades. A lot of people get into trades, or they try and play breakouts, and it's very unlikely, or it's very difficult for them to make money, because a lot of the time you get fake outs, because you've got this break, order books get extremely exacerbated on lower time frames the opposite direction, and then you get a flush back down, you find support, and then you go. But by then, everyone who's in the breakout trades run out of money trying to play the breaks here, and then they haven't got any ammunition left to play the actual move, the swing. So, obviously this is pretty much exactly what we're getting. It's a little bit higher. It could come a bit higher. We've got basically about halfway there. But obviously these types of ideas, sometimes I do them pinpoint. But a lot of the time, guys, what you're doing here is you're kind of tracing out the general direction. It's very difficult to completely pinpoint the actual dollar, especially in Bitcoin, because those order books are so live in terms of everyone's freaking on leverage. So, the velocity is much more difficult to predict than the direction in trading, for sure. Yeah, so 0.25 is interesting. At the end of the day, guys, I've said from the beginning that I think 0.25 was the most probable one. I would have loved to have heard 0, because then we know that the Fed have actually fucked something up and they're scared, and they're probably going to bring down rates. But 0.25, the next meeting we have with FOMC is probably going to be 0. And then rates will begin to come down. And then actually I do see some of these markets having a crash because of that, because I do see a correlation between this. Where is the freaking goddamn legends? Can we please hurry up, sir? I got this bloody music in my ear. I don't know if you guys can hear it. It's like fucking some sort of emotional, would you like to fucking dump the Fed? That's my closest representation of trying to sing like an American fucking require. But yeah, so that's what we're looking at right there, Leggies. 0.25% is out. If you guys hit that like button as well, then we're going to get the meeting going. I'm going to comment on what they're going to say. The Dixie's taking a huge dumperuniente, is it? Let me have a look at Dixie. The Dixaruniente. Why is Dixie not at the top? Come on, Legends. I suppose NASDAQ obviously is fucking indices, so. Yeah, Dixie is taking a dumperuniente. Good call. Good spot there. You know, I still think Dixie's going to find support. I just think that's the first initial, you know, bear market rally, in essence, coming up to previous resistance here. I think it probably does find support for a higher low and actually does come back up, maybe back down again. And I actually do think Dixie will, you know, have another retest up here. The invalidation of that idea would just be losing the lows. And then if you lose the lows, they're probably coming back down to here, all these levels along, coming further down. But I think Dixie does actually probably support, you know, find support, sorry, at a higher low. And actually probably breaks out. And that would be, you know, people just running into cash risk. I think also when the Fed are going to pivot their rates, you know, and come back down with the inverted yield curve, I actually do see a scenario there where we could see a capitulation in risk in terms of SPX. Got to keep an eye on this though, guys, because if we lose this support here, it's a very quick move. A lot of the time, guys, with these ascending formations, when you get a breakout, you get a fake, a false break or a fake out. And you can see here, guys, that actually this is exactly what we're trying to get right now. So at the moment, it's beginning, you know, it's holding support. So there is a buy here, like I said before. There is a buy at support. But you got to be careful because if you lose here, you lose this region. Come back down, see it as resistance. You're likely going to get some sort of flush because that all gets invalidated very, very quickly on the downside. But like I said before, guys, on the stream, I said like there's a nice little long to be played just here. If you got in, guys, well done. But it's obviously super high velocity scalp trading right now. Super mad fucking price. Here we go. We're in. I've turned the volume up. I think you can hear it, right? Or have I just turned the volume off? Right, let's watch these motherfuckers. See what they have to say. They've done 0.25%. Let's have a look what they go. We'll keep the chart on lower time frames to really witness some absolute craziness. Get the popcorn out, guys. If you can hit that like button, that'd be absolutely great. Desecration is key. You know what to do. When you desecrate that like button, more people come into the stream. Bring out the popcorn. Let's do this.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector.
Dumping. He speaks
in the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone.
12%, mate.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%.
Well done, pal.
Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate.
Wow.
And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year,
I'm short
and
from
28,550. The process of getting inflation back down to 2% has a long way to go.
It's dirty.
And is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Bang. Now we've broken trend.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American
exactly what
people.
I said, guys.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation.
They're saying
Instead,
it's not.
we now anticipate that some additional policy firming may be appropriate.
Interesting.
We will closely monitor incoming data and carefully assess
Now it's gonna
the
come all the way back
actual
up.
and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SCP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors.
Look at that.
These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions, meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation.
Like this right now, if you think
we remain
Powell
committed to bringing inflation back down
boy.
to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
Dump it. Ooh,
To conclude,
my short is
we
going to look
understand that our
beautiful with a
actions
short on
affect
my
communities,
deck.
families, and businesses
It
across
was only like
the country.
10K contracts, though, so
Everything we
it's nothing
do
big, but
is in service to our public
yeah,
mission.
throw the money at the wind, money.
We at the Fed will do everything we
Throw
can
the money at the wind
to achieve our maximum employment and price stability goals. Thank you.
Throw the
I look
pasta at the
forward to
wall
your
and see if it
questions.
sticks. That kind of money. Only 10K short, but I know.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity.
Sound, is it?
We took powerful actions with
Fucking
Treasury
16th
and the
biggest bank just
FDIC,
went
which demonstrate that
to zero,
all
mate.
depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough
25.
internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike,
baby.
And to change our guidance, as I
Guys,
mentioned,
hit that like
from
button.
ongoing hikes to
the Fed is saying they're going to bail out every
some
freaking
additional
bank
hikes,
with
maybe.
a
Some
guarantee
policy
on the
firming may be
deposit.
appropriate.
It's ridiculous.
So
Which
going
means that
forward,
the bank can take more risk.
As I mentioned, in
They
assessing
gotta
the need
fall back, they
for
can take
further
more moral
hikes,
hazard,
we'll
which
be
we
focused
spoke
as
about earlier.
always on the incoming data and the evolving
And,
outlook, and in particular on our
in
assessment
essence,
of
banks
the
take
actual
more
and
risk.
expected effects
More
of
banks will
credit
need bailouts. The more money will come from the Fed. Higher inflation, devaluation of the dollar. If you do get bailed out from your bank,
Can you explain
the money in your bank won't have any purchasing power left.
the difference between
It's just an absolute
ongoing
joke
rate
for the average
increases
person.
and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will.
Well, yeah, you're
continue to be
spending
strong, in
300
which
billion
case
more now, so
the path will
real
look,
modest effects.
might
Only
look
300
different.
billion
It's also
dollars
possible
of modest
that
effect.
this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy.
Yeah,
may
he's
have less
basically
work
saying
to
that he's
do.
going to
We
print more
simply
money.
don't know.
And
So-
everyone's deposits are safe
Concerns that
because of the
recent
government,
hike you did today
Federal Reserve
could further
backing them up.
exacerbate the
So
problem in the banks?
banks can take more risk.
No, I mean,
Knowing they
with
get
our
bailed out.
monetary policy, we're really
Meaning more
focused
bailouts needed.
on macroeconomic outcomes. In
More
particular, we're
devaluation of the
focused
dollar.
on this potential credit
That's purchasing
tightening
power.
and what can that produce in the
Good
way
for
of
Bitcoin.
tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities.
That's what I said was going to happen, Legends.
The discount window, and also the new facility.
This would have happened anyway without this. You know, the Fed funds rate was
Nick
actually
Timmeros of the Wall Street Journal. Chair
probably
Powell, in
this
your
little bit of
testimony 2 weeks
volatility
ago,
here.
you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data?
Can you guys hear it
before
when it
you
goes pump it
incorporate
and dump it?
that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been. Remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people. It's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, the possibility
his mouth is literally an arsehole.
of credit conditions
Actually looks
tightening
worse
really,
than
really
an arsehole's
offset
mouth,
that
to be
effectively.
honest.
To follow up, have you
My
considered at
arsehole
all
is a
whether your
frickin'
primary tool, the funds
Daisy's
rate,
compared
is
to
going to be
his
enough
mouth.
to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
The shorts.
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria
Gold
Guida
on
with
a
Politico.
tear.
I wanted to ask, you, along
Look
with
at
the
that.
FDIC and the
Beautiful.
Treasury,
Climb back
the
up
Fed
to
board
resistance.
decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review.
Oh, you gotta love it. I'm short from 28,000
over that first week. 550,
so that would have been back to my entry.
What we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce
my
it,
strategy is very clear.
and,
I thought they were going to go up in the
I get
short
briefed
term,
on
like
it,
we
but I'm
have in
not
the ascending
involved
formation,
in
but
the
this
work of it.
general area we're in, I've said from the beginning that I think it's likely going to act as some resistance.
Chair Powell, Howard Schneider from
on
Reuters.
some level.
So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely, absolutely the same. The story is intact. So it's really 3 parts, right? Goods inflation's been coming down now for 6 months.
Doesn't he?
It's proceeding more
Making all
slowly
laugh
than we
and
would have
chuckle.
liked, but it's certainly proceeding. Housing services is really a matter of
you're not
time
getting a laugh
passing.
from
We
me,
continue
mate.
to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature.
Absolutely.
The question is, how
bombastic.
significant will this
What are you
spread
guys in the chat?
tightening
Tell me
be,
right now, long or short,
and how
L or S?
sustained will it be?
Long or
That's
short?
the issue.
Put it in the
we don't
chat
really see
right
it
now.
yet.
Let's have a look
It's
what we got.
So people are making estimates.
And put your
people
position
are publishing
entries in
estimates,
and
and
exits.
but it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us,
someone said
we'll
before,
be paying attention to the actual.
Shall I get short now because your short is from 28,550? Well, at the end of the day, my position's already kind of gone into its
Hi, Chair
profit and
Powell.
come
Gina
back
Smiles
to
from the New York
nothing.
Times. Thank
So
you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
More socialism.
And
bail out
the
big
final
banks,
point,
though.
You know, can we feel
They're
confident that these
incompetent
weaknesses
and
don't
they have too
exist
much
elsewhere,
risk
given that
exposed
they've
to interest rate risk and
These are
didn't
not
hedge?
weaknesses
Okay,
that
well,
are-
let's
that
bail
are
them out
at
for being a
all
bad
broadly
company.
through the banking system. This was a
Let
bank
them
that was an
fucking fail.
outlier in terms of both its
And
percentage
then someone else will come in and pick up the bill and do a better job and be more efficient.
uninsured
Let the
deposits
market run.
and in
Free
terms of
market.
its holdings of duration risk. And again,
just
supervisors
bail out
did get
banks
in
when
there,
they
and they were,
mismanage
as you
people's
know,
money. Otherwise, they're never going to
obviously,
do anything. They're not going to manage
they-
people's money
they
any
were-
better.
They were on this issue, but
People are
nonetheless,
going to get hurt more
this
and
still
more.
happened. And so that's really the nature of the interview.
And then they're going to get bailed
sorry,
out.
of the
That
review,
causes inflation
is
because they
to
print
discover
money and devalues everyone's dollars, and fucking you have less purchasing power in your bank.
Michael McKee from Bloomberg
So it's great.
Radio and Television. You've been very
Bitcoin, but
consistent
it's
in
bad for
saying that
everyday
the
people.
Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something
rant
different
after
about the
meeting
way
ends. Maybe
you're
we'll get
looking
a
at
rant
it,
out
given
of the way,
that
yeah.
you're now thinking that
I've just been on this rant for
moves
so many
might
years,
be
though, it's
appropriate
getting to
as
the point where
opposed
it's
to
like-
ongoing?
So we
What's the
published an
point?
SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on being,
Look at this price
it will
action,
be
man.
sufficiently restrictive,
it's
or
cheering me
is
up.
it leavened by the idea of you don't
Powell's
know
making
what's
me
going to
depressed.
happen? In other
The
words,
price action's
what
cheering
should
me
people
up.
think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among
Yeah,
the
sure,
banks
it's looking nice.
and asking,
Could just
is there
take it
going to
off,
be some
'cause at the end of the day,
tightening
we
credit
come to
conditions?
entry
And then
again.
we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from,
It's a good entry,
tighter
though.
credit conditions. So that we're
Yeah, it's one
looking
of those
at,
positions
and
where I
we're-
could just be like,
it's
fuck it, just
highly
let it
uncertain
run.
how long the
Put the stop
situation
into
will be
break even
sustained
now
or
and
how
just
significant any of those effects would be. So we're
leave
just
it
going to have to watch.
just for the safety net
In the
of
meantime,
us dropping down significantly further. But
and obviously at the end of the day, we will do enough to bring
not like I
inflation
need the
down to
profit right
2%.
now.
No one should doubt that.
it's a nice hedge against my longs as well. Yeah, entry price for me is 28,550.
Hi, Chair Powell. Rachel Siegel
Mark
from the
price
Washington Post. Thank
28.1.
you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans
take
that
off
will
what I
begin to
entered
roll
and
over later this year
retweet.
and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question. Would you be
Ooh,
open
big
to an
words,
independent
analogous.
investigation separate from the Fed's probe?
Mr. Powell's got a
welcome.
nice vocabulary,
It's
sir.
100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a
He's
bank
hitting me with the
fails,
big questions.
their investigations. and
F22
of course,
Danielle.
we welcome that.
It's a long rabbit hole. Going into
Edward
how
Lawrence
you
from Fox Business. Inflation has been rather
determine the
sticky.
definition of
So,
inflation,
do you need help from the
what
fiscal
supply and
side
demand means
to get
you?
inflation down
It's a
faster?
big question.
We don't assume that. We don't give advice to the fiscal authorities, and we
there's a couple
assume
ways you
that,
could answer it, but I'll let Powell.
we take fiscal policy
carry on with his
as
bollocks
it
and I'll
comes
answer in
to
a
our
minute.
front door, stick it in our model along with a million other things.
Stick it in your
and,
fucking ass, mate.
We have responsibility for price stability. The Federal Reserve has responsibility.
Stick it in our
for that,
model.
and
Nothing's getting
nothing's
stuck in
gonna
any
change
models,
that.
bro.
So
We're coming for
and
you,
we will
pal.
get inflation down to
We're coming
2%
for you,
in
dude.
time.
And if I could follow on that,
Even though
but
he
they're
is the
working-
best marketing team, he is
spending
one of the
that's
best
happened is
marketing
working
officers
against what you
for
were doing, right? So it's prolonging
Bitcoin.
inflation.
if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Dude, what is he talking about? He's saying like.
Hi, Chair Powell. Neil Irwin with
not
Axios.
printing money.
Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank.
He doesn't even know what he's talking about.
That's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
I hate Powell, but I can't not secretly love him because
thank you, Chris Rugaber,
he is the one who's actually going to
the SEC suggests one more rate hike, as does the change in the language in the statement.
He is the ultimate marketing officer.
And which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is, and we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point
I'm sick of having this in my ear.
Being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working, and of course we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Long-short ratio is still super short.
Hi, Chair.
Doesn't mean we can't have a stop-off.
with Bloomberg News.
The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent?
Why didn't the Fed do anything about
what happened
that?
this
Why
month?
didn't you do something?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting
Sounds like
7
he's in
weeks.
fucking court.
But I will tell you though that
joke.
there have been presentations about interest rate risk. I mean, it's been in all the newspapers.
What are you guys,
It's
long or
not
short
a
term in the chat?
surprise that there are institutions that have.
I've got him in my ear, so I can't really
unhedged
speak
long
'cause it's
positions
loud in my ear,
long-duration
him
securities
talking
that have lost value
facts in my ear.
as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public
guys,
record, the supervisory team was apparently
engaged,
very much engaged with the bank.
Show you what it's all about.
Repeatedly and was escalating, but nonetheless,
So that's
what
what we've
happened
done?
happened. And so that's really the
pumped
purpose
and
of
we've dumped.
one way to think about
Pumped
the
and
review
we've
that
dumped.
Vice Chair Barr is
let
conducting,
me
is
get
to try to
this tweet.
understand how that happened and try to understand how we can do
Right, I'll
better
do a giveaway
and
on
what
this
policies
tweet.
we need to change. I mean, one
Go
thing
and like,
is
retweet, and
the
comment on
speed
that
of the-
tweet.
I'll come back to that.
Go
The
like,
speed of the,
retweet, and comment on that tweet.
Of the run, it's
I'll
very
pin that
different from
message,
what we've seen in
and
the
you'll have a
past,
chance
and
to
it
win
does
MDX
kind of
Algo. Let's do
suggest
an MDX Algo giveaway.
that there's a need for
Let me
possible
retweet it again,
regulatory
so
and
it's at the top.
supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you
Pretty
confirm whether or
done.
not the board
Perfecto.
knew about
Yeah,
these
like it, retweet it,
escalations
comment
by
on it
the,
saying, well, hey,
examiners
something
in
about
San
the market,
Francisco?
and I'll give away one of you legends, MDX Algo. I gave away three.
We'll have to come back to
I've given away 3 from a tweet I did. I got to do the 3 from yesterday.
Simon Urbanovich with The Economist.
Obviously, let that
Thank you
video
very much.
grow a bit
Chair
first.
Powell, you've stated twice today that
And then,
all
I'll do
depositors'
another one on
savings in
this
the banking
stream
system are
live.
safe. Are you saying that de facto deposit insurance covers all savings?
Oh, God.
Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors?
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to
We're about
protect
to get stopped
depositors
out on the
when,
bot as well, so we'll take profit
there's a
if
threat
the hourly
of
close.
serious
Look where we're
harm
at.
to the
That's
economy
just
or
our start of this
to,
hour.
or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really
gorilla
the
in the room.
Swiss government. We, of course, were
Bit of a random
following
thing
it
to
over
say,
the
isn't
course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome.
We
in
get
the
an hourly
sense
close
that, the transaction
beneath
was
that
agreed
level on the
to, and
chart.
it has been, the markets have
That's when our
accepted it. and,
automated trading system will sell.
It
and
seems
take
to have,
profit from the long,
gone
that long
well,
it's
and
up
I think there was a
from-
concern that it might not go well.
That was
So
one of my nice
coming into
positions
the
on the long
middle of
side.
this week, yes,
Got
I
long
would say that has
from
gone well
21.
so far.
4. I got long from 19.6. So I got 2 big longs, one here and one here. All these green dots here, guys. For me, I use this
Hi,
to
thank you, Chair
analyze
Powell.
funding
Nicole
rates.
Kind with
And
CNN
it was a good
Business.
time to buy, and obviously
In the summary of economic
recently.
projections, the FOMC sees the unemployment rate increasing to 4.5% this year.
What did I say,
I'm wondering
legends?
how you
Pump
anticipate
and
preventing
then
this from
dump.
snowballing while using
Pump
the
and then dump.
admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain estimate, and I mean there's really we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir.
She looks freaked out.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
It depends on whether
if anyone's using the MDX trading
recessions
bot,
tend to be non-linear.
when this closes,
and so they're very hard to model.
This is just showing us a representation of our automated system.
If you
that will
have more
be
of this, you
a
get more of that. But when
take
a
profit,
recession
in essence,
happens,
obviously it's just
the
getting
reactions
stopped
tend
out
to be
on
non-linear, and that's what
it's
so
laddered.
We don't know whether that'll happen
stop
this
loss.
time. We don't know. If so, we don't know how significant it will be. And so
if you're using the MDX trading bot, guys, you'll see
we're very focused on getting inflation down.
That's, from the trading bot side,
and
you come here
because we know in the
follow
longer
the trading
run
bot.
that is the thing that will most benefit the people we serve.
1,300%.
That's how we can have a long. We've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and
so
they're
we've got
very
about 50
good for
minutes
people.
to the early close.
Late
that
in
will
expansion,
get that in
you
profit.
see low unemployment. You see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
You can get the trading bot from mdxalgo.com. Well, go to mdxalgo.com/dashboard.
Chair Powell, Jean Young with Market News.
It's completely free,
I just
Legends.
wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing?
And then click
US
trading. Click trading bot.
It's too early to say really.
All you got to do is get a Bybit account, BitGet account.
Whether these events have had much of an effect, it's hard for me to see how they would have helped the possibility. But I guess I would just say it's too early to say whether there really have been changes in that.
We've got a tutorial coming out.
The question will be how long
use
this
the
period
links here
is
as well. So you
sustained.
click
The longer
start
it's
copy trading or
sustained,
start copy trading.
then the greater will
you have
be
to use those
the,
links when you sign up to get access to the bot. We're actually going to have a new partner as well
declines
soon with our trading application. So you need to sign up with those
standards,
links, and then you can
credit availability.
click
So we'll
start
just have
copy
to see.
trading. And then you
I
can
do still
actually
think
use
though
the
that
MDX trading
there's a
bot.
pathway to that. I think that pathway still exists. And,
Traditional strategy, long-term swing, medium-term to long-term swing trading strategy, which has been back-tested for decades.
Hi, Chair Powell, Nancy Marshall,
8 years, and I
with
know people have been
Marketplace.
using it for a long
Just
time.
wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious.
Yeah, guys,
those are serious
like
regulatory, particularly
like it, retweet it, and comment on this tweet.
That's
on my Twitter, it's
I
the
guess there
last
were
tweet,
6 of them.
and then I'm going to give away
And
MDX Algo.
getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the
got a real nice short open.
The
right now,
review
guys.
will be doing under Vice Chair Barr's
But I think I'm just going to leave this
So
one.
that's
put it into break even and just leave it.
I think that's what
we
you
could
think
get a
about.
significant
What
drawdown.
can we do to make sure? But again, that's not for me to answer
So you
today.
don't have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review's going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this,
Nice.
to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right
big
now?
dumps, big dumps.
If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation
$6 million
warrant
on the
a
sell
rate
right
cut?
there.
What situation would warrant
Did
a
you
rate
see
cut?
those $6 million
And
sells?
have the bank
3 and 3.
failures prompted any discussion around changing the
Gotta go dump
implementation
it.
of the balance sheet runoff? Thank you.
Love it.
So we haven't really talked about changing the balance sheet.
That's what I said, Legends.
Implementation.
I said it's a pump, and then it's a
That's not
dump.
something we've discussed yet. As I mentioned,
Said it
we're
from the
always
beginning.
willing to change that if we conclude that it's appropriate.
Short-term
but we're
upside,
really not
medium-term
seeing any signs
downside. I
there.
said it in my groups, said it
Sorry,
on my
then
video.
the question before that was...
Said it all over the
just
gaff.
give me
I'm short from
Curious
28,850.
how you view financial conditions now, and if
Yeah,
credit were
okay.
to tighten enough, if that would prompt a rate cut.
Oh, God,
So,
not this woman. She's just like an alien.
Financial conditions seem to have tightened, and probably by more than the traditional indexes.
Yeah, go and retweet
say,
this, like it, and
because
comment
the
on it,
traditional
and you'll have a
indexes
chance to win
are
MDX algo.
Focused a lot on rates and
Obviously, you get the
equities,
indicators, you
and
get the
they don't
algorithms, you get the
necessarily
trading bot. But guys,
capture,
I'm not joking right now. Like the trading
lending
bot is completely
conditions.
free. All you
So
do is come to
we think that, though.
mdxalgo.com/dashboard,
So there are other measures which
pin message
if
on
they're
the
focused
chat.
on,
And
you know,
just use
bank
these two
lending
links. So
conditions
click,
and things like that. They show
click
some
start
more
copy
tightening.
trading.
The question
and
for
start
us,
copy
though,
trading
is
here.
how significant
And then
will
sign
that
up
be
with
and
those
how,
links.
you know, what will be
You
the
need a new
extent of it
account
and what will
with
be, what
Bybit
will
or
be the
BitGet,
duration of it.
and we've got a tutorial coming out to get you set up, and
you
it's
know, once
completely free. Just gotta use
know
Bybit
that,
and BitGet. That's why I get my cake
there's
back,
a fair
basically.
amount of research about how
not
that,
from the
how
actual
that
trading bot
with
itself,
broad
but
uncertainty bands,
from the
how that
referral
works its
to
way into
Bybit.
the
I
economy
actually want to
over
make
what
it so
period
it's
of
0%
time.
I take from the
you know, so we'll
the
be
profit
looking to
from it.
see the first
But
part of
it's
that,
going to
like
get
how
stopped
serious
out now.
is this, and
In
how does it
quite
look like it's
likely,
gonna be
actually, it's going to get
sustained?
stopped
And
out
if it is,
in profit.
you know, it
If
could
we do
easily
wick
have
back
a
up, it won't
macroeconomic effect, and we would
it
factor
won't
that
take
into
profit
our
because it
into
needs
our
to
policy
close. You need a confirmation close.
I mentioned with rate cuts, rate cuts are not in our base
see here.
case, and you know, so.
But yeah, it's completely free, guys.
That's all I have to
mdxalgo.com.
say.
Go to the
So.
dashboard.
Thank you
I've
very
made
much.
Millions and millions of dollars using this strategy in essence. Obviously, I don't use it on copy trading because I just use the strategy myself. Is that it then? God, fuck it, we made it! I can take it out of my ear! The event has ended. I can now speak with my own mouth. I don't have to listen to him blasting off with his fucking bumhole mouth. His mouth literally looks like an anus. So I'll just put this on just for some background shit. I don't know if that's going to play, is it? Yeah, it's probably going to play. Let me turn that off. So we'll leave some stuff up, guys, and we'll go through some charts now. We'll talk about the meeting, and then I'll show you some other shit. But yeah, it's very, very volatile right now, legends. I'm liking that, to be honest. We had that meeting, first initial, you know, when he actually announced the rate, volatility. Look, so you see we're wicking up now, guys. You're probably going to see that now, look, now the bot will not sell. So if we do get a wick on this, which is quite likely, actually looking at the velocity of this move, the bot will still be in an open position. But guys, it's completely free. mdxalgo.com/dashboard. Tell me in the chat what you think about the rate and his meeting. I had a few questions about, you know, oil prices and stuff like that. You know, here's the thing with all this shit, okay? With the shouldn't lower oil prices decrease inflation. Like, when you have a lower oil cost, right, it doesn't actually increase. I don't want to bore you to death, guys. I've spoken about this a million times, but it doesn't increase or decrease inflation because you have to think about what the definition of inflation is. What lower oil costs do is it means that prices can rise or fall depending on supply and demand. But inflation and deflation are different to prices. You know, inflation is just the increase of monetary supply. If you increase the amount of dollars in circulating supply in America, you're going to have an increase in price of things because there's more dollars bidding on the same amount of goods and services. So inflation is an increase of monetary supply. A deflation is a decrease of monetary supply. The increase or decrease of prices is a result of inflation. So inflation is the actual act of increasing dollars or decreasing dollars. The result of doing that is an increase or decrease of prices. So oil comes into it, and if you have a decrease in price in oil, you might change prices because prices can go up and down because of that. But that's not inflation or deflation. So lowering oil costs could actually create quite a good supply and demand dynamic within the economy, and it could make things cheaper because industry and businesses and things which are created with oil and traveling and moving around gets cheaper for people. So it's good. Doesn't necessarily mean there's going to be a decrease in monetary supply. So it's not to do with inflation. It's a definition thing. But yeah, guys, that's a nice little juicy move. I'm going to go monitor my shorts. Like, I've got longs from I've got longs all over the gaff. I've got longs from 19.6. This is obviously where I've been long from my bot. And I have a short now from basically the top. I will show that position for you on Twitter in a minute. You'll probably laugh. like lol, basically time the top. But guys, I literally predicted this move pretty much to a T. I've seen it a billion times. Ascending formation, you get a break on the short term, medium term, you're coming down a bit into resistance. And that's in essence what we've got right now. I'll probably do a video tomorrow, a short form video, just me explaining it a little bit further. And yeah, all that kind of jazz, guys. But go to mdxalgo.com/dashboard, guys. There's also, if you click on Trading Bot, you can get the Trading Bot for free, legends. Just create a Bybit account. There's actually a link below my face as well to Bybit. Just create a Bybit account or a BitGet account by clicking on Start Copy Trading. Because when you click on these two buttons here, Start Copy Trading actually takes you through the system. So you can actually get the Trading Bot yourself. I could probably show it actually, the actual levels we've got here. So it's literally going to take profit in a minute, I think. It's had a consistent win streak all the way along here. We've got Masters P&Ls 10 plus. Anyone who's held this for more than 100 days is in massive profit. The reason you have followers losing money is because people don't leave it for long enough. So you can see here that this is a medium to long-term time frame trading bot. So anyone who's been in this for more than 100 days has made significant profit. You can see here all the people who have just absolutely been killing it. Like this guy's been in for 150 days and made almost $1,000. Well, $700. $500, $300, $300, $250, let's say. So all these people who have held for 100 days or more, this guy's done very well in just 89 days. But you know, anyone who's held for roughly around 100 days has made money, has made profit. 205 days in massive gains. So you want to, this is a medium to long-term strategy, which is going to make you a lot of money in the long term, guys. And all you got to do is come here. This, I think, because we only launched this 190 days ago in the bottom of the bear market. I think, you know, even if people are losing money because they're coming out at ridiculous times, I think at the end of this bull market, this is going to, even if people are coming out at the wrong times, they're still going to make money on the average. Because we only launched this in the bear market. So you can look at the previous bull and bear cycles that it had in 2021. Let's have a look here. It did 274% in 21. Max winning trade of 66%. Very interesting strategy as well because it actually loses more trades than it wins. So it will lose 6 out of 4 trades. But the winning trades, those 4 winning trades it will win very, very big. So backtested for 3 years, as good as it gets. You can have a look at all the numbers, all backtested in real time. It's literally live right now. And you can use that kind of shit to help you put some money to work, you know, instead of leaving it with some fucking APY farmer who's going to get you wrecked. But yeah, we're probably going to get, go to mdxalgo.com, guys. Click on Trading Bot. You can use it. Just get a Bybit account. The link is below me. So if you use the link below, guys, Bybit, just sign up. Also, if you use that link below to sign up and deposit, you'll actually be entered to win an iPhone as well. So it's pretty simple, guys. Use the link below my face. Get a Bybit account. Use the Trading Bot. You can also win a fucking iPhone as well. And you get no fees for 30 days. So I'm just shilling it. But like, what the fuck? It's an incredible deal. I do have a crystal ball, guys. I'm not going to lie. This is pretty much exactly right. You know, arguably, if I was going to be devil's advocate against my own prediction, you know, we only came up about halfway. But this is just an idea which I've drawn. I've already got it here. And this is just an idea of a wick up and down. You know, this is not supposed to be accurate on the nail of each dollar. It's more about the idea. And that is exactly what we've got here. So this is what you get when you've been trading Bitcoin for fucking 8 years, basically. But yeah, guys, check it all out. Nice little wick there on the bottom side. I haven't been stopped out yet on the bot. But yeah, go check out all the stuff from mdxalgo.com. Use the link below to sign up to Bybit, because if you sign up to Bybit, make a new account. I think I actually have the tweet somewhere as well. I love this video. It makes me laugh. Bathing in the Bitcoin profits, sir. You might actually be able to hear this. Actually. Wait, can you hear this now? I don't know how loud that is. It's probably really, really loud for you. Little legends. Yeah, so I think the tweet's around here somewhere. I don't know. Somewhere around here there's a tweet which is talking about the giveaway, which is from Bybit. All you gotta do is just post the UID number on this tweet and you can get an access to it. Here you go, sir. So sign up with a bonus MDX, the link's below. Put the UID number on this video or on this tweet. Deposit $100 and you have a chance to win an iPhone as well. 0 fees. And you can get the MDX trading bot. So that's enough shilling already, guys. Let me do this. I'm going to let this one run for a little bit. So all you got to do, guys, is like it, retweet it, and comment on this. I'm going to scroll down and find someone to give the money to, Give the money to MMDX Algo account. So just come to this tweet, like it, retweet it, comment on it, and then I will choose someone to win MDX Algo. But yeah, guys, I'll see you later. That was a nice little sesh, and I'll do a normal video tomorrow. Love you all. Have a good time. And trade like a fucking legend, okay? Trade like legends. And also trade like degens on the weekend. You know what to go. You know what's going on, legends. See you guys on the flippies. Bye-bye.